didn't highlight because it's up here. That's
Entonces, the fancy
the laws here, the old laws. The long part, you have to finish right. It's the long part. And from low, fast and worse rates to the middle. We have to start on the stage. We have to finish all of this. Oh,
You show it down.
we have to finish all of this. To finish French. Look, and you all know we was finishing 5 days.
Yeah.
So, and that's all here. Cut out some stuff. So, one of them, yeah. So it's gonna be on the test. So we go another week, or it won't be on the test. You all understand what to do with the paper?
I think I have a idea, but I guess you could explain better to me.
Oh, no, you don't have to explain that better. I told what I thought it was.
Exactly.
When I was
It's the last part.
Okay, when it was explained to me by someone else, I said, oh, now I get it.
Yeah, someone has to explain it to me. That's probably why I got it.
So, I mean, you have to explain it to make sure that I am on the same agenda. But he is. I didn't give you the talk.
No, you got it in your hand, you know. It ain't at the bottom. No, the bottom of the bottom of the hand.
And it was right there.
You have it right
Yeah, I
here.
have it. I have it.
You have it? Okay.
Really?
Yeah.
Really now. We aren't that.
No way. Not for all that one. At the beginning.
Oh, can you make it lots of big?
Good afternoon.
Hello. How's everything? Hey, that's okay. That's okay. That's fine. Yeah, that's what matters. Let's start it. Can you do this so you take a picture like this, like instead of a daily, like on Tuesday? Like, right, so they show up. Yeah, that's that day.
Let me see where this place is on fire trail.
Let's see.
Can you send you the location?
Let's see when you show up. But yeah, that was good. Okay. Yeah. Okay. That's my team. Yeah. Like that.
So here we are already, and again, doggone it, another week has passed. Exam already next week. Time is on a roll. I'm trying to slow stuff down, but it will not be slow. Correct.
And the paper is the one over.
Correct. I'll give the others a few more moments to settle down. I need to say that to everybody again. Come right in. How is your reading, studying coming? In the old days, we used to say no news is good news. I don't know what that silence means. Okay, I'll assume that means it's coming.
Okay, we have read.
Sorry?
I said we have read.
I hope you've read and read ahead.
We have read the whole section.
Good, then
Nah.
you're well on your way.
We're like, it's a whole lot to
It's a whole,
remember.
yeah, but I know, studying stinks. I've been studying for many, many years in my lifetime, and I know it sucks. But the secret to studying is to start early. That's the first secret. The second thing is, once you start early enough, like right away, don't wait till the last minute. That last minute thing, that is what makes your life miserable. But if you read up ahead, you start early, blah, blah, blah. Then what you do is, everybody has a different study style. You find your style, and then you just keep going over it, over the main important thing, over and over, until you get sick of it.
But how do we know what is the meaning of it?
Oh, now that's the age-old thing for students. I've asked it as well as a student, like, what's the important thing? And like you will probably hear most of the time, everything we discuss is important. We even had lecturers sometimes who would throw stuff that you didn't discuss, assuming that you would have checked some other egg for some reason. I don't know why, but there'll be no surprises on your test. It'll only be on what we've covered and talked about on the credit side, okay? So usually the main, you notice my notes are, they have like a bold main heading, and they have like some information, all that stuff you read. Like, so what is a credit policy? Why is it important? See, know those things. What are types of loans are there? List 3 types of loans. So if you only study one, and you can't do that. So you have to learn that crap, so that, and if you do it like that, like the real key stuff, you guys will have an idea of what's just like extra detail versus what's important in terms of definition and concept. Make sure you know the definitions and the meaning of stuff. And like, for example, you might get a question that says, list 3 of the 4 concepts underlying the credit agency or whatever. So those kinds of things. Those things are in black, those main points, those sub points, like that. I know it stinks.
Okay.
But the key is just keep going over until you get tired of it.
Listen here, this, the credit score example. FICO doesn't make any sense.
FICO?
Yes, if very poor, I guess it's for the black people. Very poor is 300 to 579.
Right.
But if you white and you 550, you okay.
Many times, that's unfortunately the truth.
So why 579 is very poor and 550 is poor?
Yeah, it stinks. This is certainly not a perfect method. Trying to get an explanation from them. Good luck with that. There's none you can get from them directly. It's just this, it is what it is thing. And for those of us who could somehow influence the system, which is another issue. It's like you work in your organization, you see something wrong, trying to get them to like even pay attention to that particular thing is a big headache. It's kind of like that. I agree with you. All right, the variations, like what the hell? It seems to be a setup in many instances, and unfortunately, it's true. The whole credit score thing is a kind of quote unquote setup in many ways against certain groups, certain ethnic groups, certain economic groups, and so on. And I hope I'm wrong, but not particularly. And so you just have to, yeah, it's tough. Hopefully when they set up our credit bureau here in the Bahamas, does anybody know which company is going to be dealing with that credit bureau here?
No.
But it says operated and managed by an Italian firm.
Yes, who said that?
There's something in the paper on
Oh,
Monday.
you're right here on the ball. Yes, it is there, operated by an Italian firm. So an Italian, no Italians in here.
No, sorry. Because we're crazy.
Nothing.
We don't like to work.
Now, just like with the credit score thing, who in this class have the clout or influence to try and find out why the hell we picked it? An Italian, no, well, yeah, we had to prove it. We, when I say we, I mean the government of the day, along with the central bank, etc., had to approve it. We don't have any idea who was involved in that approval process or what the criteria was. So now our loan information at certain banks in the Bahamas and Trinidad, our call center that Bohemian should be answering the phone to connect the call to Tuchocon and all that is down in somewhere else. And now the credit bureau is being run. You have a point, it's a setup. Question?
We aren't sure as a collective group exactly what you want, but this is it.
I wonder why. Where's the uncertainty? Let's see if we can.
Are we to build a to make a credit policy?
Does it say make real one?
No, it doesn't.
No, what does it say?
Discuss.
Statement is valid in support.
What are you proving? What comes before the end? Indeed. In other words, we're saying with those things in place for credit and collections, it'll, and then you have to discuss it. So that means like, yeah, you have to like call on all your little stuff you learned and just have a long discussion on it. Not long, but you know what I mean. 5 papers or more, print, type. So what does that mean? You go back to the beginning of our discussion and then you just kind of work the concepts in. Don't create a credit policy.
All righty.
Okay. If I wanted you to do that, I would have said specifically create. Yeah. No, not at all. I'm glad you asked that so you don't do that inadvertently. Just go ahead and okay, every company that has credit collections policies, and these are designed to do this, and this, discuss it. And so you'll go back and talk about what a credit policy is, why it's important, why firms need to have it, what a collection policy is, why is it important, what does it cover, how do you get to reduce losses by contacting customers on time. We'll get to all that. How do you deal with credit? We'll be talking about that today. All right. All the history that we've done so far, and then we'll be talking about the credit application, what goes into it, and all that. You use that information to build your paper. Okay, that's the key. All right. by all means. So don't recreate anything, just use the facts that you have to say whether or not the statement is a valid one. So after you've done all of your research and
And the
stuff out there,
conclusion.
yeah, exactly. Then you can come back and say, hey, this is a valid statement because all these things are designed to do this exactly. And you'll be good to go. Any other questions before we go on? Of course, you can raise these questions anytime you wish along the way. Your paper is not due until on or before. Okay.
Making a payment date.
Also, since your examination is next week, this weekend, don't plan anything exciting. COVID is here anyway, so you don't have anything to do.
Things is happening.
I know, crap happens, especially during exam time, for some strange reason. But try not to plan anything so you can spend your whole weekend as well, studying, reviewing over and over until you get sick of it. When you feel sick, vomit, sleep, and do it again. You can vomit, sleep, and do it again. Keep doing it until you're tired of it. That's what you do. So by the time you get to your class and do your exam, you say, man, I know a great deal of this stuff. I'm sick of it. That's the key. Now, if you don't make that kind of commitment, you're going to get some funny results when you see the paper because you're not familiar enough. So the key is to keep going over, make your points, read the core things, read it over again, it stinks. But unfortunately, that's the nature of studying.
Yeah.
Some people get things quicker than others. So some people read stuff, they remember crap for some reason, and others, man, we have to, man, labor over it. Okay? Like my baby hates studying, man. He used to labor, say, Dad, why the hell I have to do it? So I get it. Okay? And trust me, I've done my share of laboring as well. Not everything came automatically.
I
So
would
I
I hear,
understand.
but
It's a small world. That's true. I was a little more fortunate. Worked hard, but a little more fortunate. But it didn't come without a whole bunch of blah, blah, blah. All right. An example, for example, the page that has credit risk, I'm not sure which page that is. Page 3 or 4, whatever. Says, what is credit risk? And then you see those 4 points. Credit history, total debt. Yeah, you see that stuff?
Yeah.
So how did they arise? What caused us to discuss those 4 things? Is it the light is off? Is that my imagine?
Lenders use this to judge the borrower's creditworthiness, the
Yes.
ability to pay back the debt. Yes, there is life. Those words.
I can't find the switch when you want it. What the heck is it?
It was on for a minute.
This one?
Yeah, all
From
of
where?
that. I don't know. I thought you had touched something out there.
No, it was on for a minute?
Uh-huh.
Okay, let me touch something again. Tell me if you see something.
Yes,
It's on?
yes.
Right. Yes, perfect. So yeah, those things came up when we were discussing credit risk. And so a range of factors go into the assessment of credit risk. So that's an easy question. Again, what are the 4 factors that come up? See what I mean? And then you would say, oh, that's easy. Credit history, debt service, like that. And so when I say study the key stuff, that's what I mean. All right? Once you've read through the stuff, don't spend a whole lot of time with the detail, like once upon a time, there was something called credit risk in the middle of the day. And no, you already read that. Just focus on the key points. Usually they are very clearly highlighted. Okay? And you'll be fine. Then you keep going over and over. List 3 of the credit management practices and techniques. See, you learn things like that. That's what I mean. Because that's how I'm going to ask a lot of the questions.
Credit assessment.
just to make sure that you
Credit
have
analysis
reviewed those
and
things.
scattering
Yeah.
credit risk.
What are the types of credit risks on the next page? 1, 2, 3. Default risk down. You see that?
Yes, I
Yeah,
saw
I'm gonna
that.
ask questions like
I
that.
got that.
So,
Yeah.
so I'm gonna ask you to list some of things, and I'm going to ask you to like define some of them. So you're gonna have to be able to list them, and then in some cases, explain briefly. No rocket science. But you won't be able to like not study and say, "Oh, well, just wing it." That's not gonna work. The wing thing won't. You will have to make a little commitment to the task. All right. Moving right along. Anybody remembers where we stopped the last time? Not yet. I think.
We would have seen
Hi, come right in. Grab a chair.
importance of.
Oh, the importance of the credit policy.
somewhere
Yes,
there.
absolutely. So we can see already why the credit policy is so important based on the conclusions. Remember we said whoever was reading at the time that it's a living document, means that it can be changed from time to time to update. It must be applicable to all your customers, not some. And then finally, it must incorporate what?
The company goals.
The company goals and objectives. So these conclusions pretty much tell the importance of the policy. Okay. And then a few more points were made at the bottom about the important components of the policy, that it must be seeking to maintain what? Cash flow. How do we do that?
By
Simple.
mitigating loss.
Yeah, by giving what? Good loans. That's all. There's no like rocket science. That's how you maintain cash flow. The better loans you give, the more loan payments are going to come back. So more loan payments come back, the better the cash flow of the lender. If you give bad loans consistently, the loans are going to start what? Payments are going to start slowing up because you're giving loans to customers who probably could not afford those loans. And therefore your cash flow is going to suffer because loan payments are going to slow down if you're a lender of any kind. Okay? So cash flow is important. Then the risk of bad debt. Good loans do not result in bad debt. Bad loans do. You follow? There's a trend.
Mhm.
Okay? And of course, the management of debtors. Who are debtors? Borrowers. How do we manage them? When they become delinquent, we call them when? Right away. When they say they're going to pay in a week, we call them when? One day after the week. Like that. You don't like put it over there and say, I'll get to them when I get to them. Debtors don't work that way. If you don't follow them up on a consistent basis, you're going to start having a problem. So the key is give good loans so the payments can come in for the majority of borrowers. And anybody who stops paying for any reason, find out why immediately.
Mhm.
That's it. Even if you give a personal loan to your friend, you have to figure which friend to give a loan to, who is likely to pay you back and who is likely not to. Those who you believe will not pay, don't give them loans, or just tell them this is not a loan, I'm giving this to you. And those who expect to pay back, fine. If they say I'll pay as soon as I get my ASU, what should you ask them?
When the ATM
Exactly. So you guys get the idea. You don't just say, okay. No. For your whole 100, 300. And notice the greater the loan amount, the more concerned you should be. That's why lenders are just like that. The more money they lend you, the more of a headache they're going to be to you if you don't repay. Because they know that a great amount of money is what? At risk of becoming a bad debt. Okay? So we know from our own personal experiences how we should behave professionally when it comes to lending and collections, as we'll see. Then the credit analysis on the next page talks about how to evaluate the loan. We'll talk about that later. But the analysis is huge, perhaps the most important process. It is the thing that helps us determine who might be a good customer, who might be a bad one, who to say no to, who to say yes to. Okay? Just like when you're getting married. Sorry. All right, so yeah. Who to say yes to, who to say no to, very important. That's why when you go in to borrow, they put out a loan application, which I put in there for you to have a look at. And if anybody's looked at it already, you'll see it has some very specific questions if you've never borrowed before in your life. And if you have borrowed ever, you'll know from experience that the loan application is designed to capture some key information so that the credit analysis can be what? As complete as possible. Okay, by all means. And then when we get to the collection policy, we'll see why that is such an important document. But we won't say anything about that now because we want to focus on credit right now. We have bigger fish to deal with between now and next bloody week. Now and tonight. All right. So what are some of the types of loans that we have out there? Well, I gave you a whole list, and that's a nice test question potentially. Right? List and define 3 of the loan types of loans that we discussed. Yeah, simple like that. But if you never looked, and I'm not looking at that.
Auto, personal, business, small business.
Payday loans and credit card loans. Why is a credit card a loan? Like some people think that thank God I have a credit card, I don't have a loan.
Yes, the Lord, that your money you use.
You'll be surprised that people think that the credit card is not a loan.
But what do they think it is?
You'll be shocked what they'll tell you. We know it's a loan. We know it's a revolving debt because you have a credit limit and you can continue to use the card up to that limit
and then pay it down and then use it
That's why they say it's revolving like this,
right.
Going around and around. But there are a lot of people who have a credit card. They have no idea really what it is academically in principle. All they know is, thank God I have a credit card. I can go until I max it out, and then I'll pay the minimum And how come I can't get more if I keep paying the minimum? Because they don't understand the minimum means that 50% of it might go to what? Interest. Of course. A lot of people don't know that until.
Why my credit card balance ain't going down?
Yes, I paid $100 every month. And
only $30 seem to go to the principal.
Absolutely. So a lot of people have that problem. So, until you do what? Seek to educate them. And sometimes, depending on who they are, educating them is a little more difficult than the other person because people have different levels of understanding. So the sophisticated way that you tell one type of client, like the lawyer or the accountant or some other big educated person, you can't go to people over the hill with that same conversation. Like kick back and you try to use the same, that's not gonna work. They said, excuse me, I don't understand what you're saying. You showing off? You trying to show me off? Acting like I don't?
The mistakes that bankers make, they tell them you have your minimum payment, for example, if the limit is $1,000, they'll say, okay, your minimum payment on this card is $50. So people think every month they have to pay $50.
Yes, they do. They think that that's all they have to pay.
By the bank?
No, I mean, instead of going into debt and saying to them, if you use a
She is right.
then it ain't gonna be $50. And they take that assuming that it's a plus $50 I have to pay every month on this.
Indeed. See,
there
are some people in the jungle. When I say the jungle, I mean the jungle of the world who understand how this crap works. But not everybody. When you tell somebody that $50 is their minimum, some of us know that that's the minimum, but that's egg. And that a portion of that is going to go to interest and only a little bit is going to go to principal. Some of us know that. But there are many, many people who have no idea about that until you actually explain it to them. And then they'll be like, what does that?
What do they think the bank give them the credit card for?
They just don't know.
Give them the money and not trying to make anything from it?
No, they're not interested in what the bank is making. No.
People sit down and the loan officers explain to them what the
payments
are, but they just want the card. They sign it and they want to go. And by the time I have to call them, someone called me and it's like, oh, all the money on the card go. When you're gonna talk to me up again? Pardon me, ma'am.
Of course. And some people, they don't.
I didn't understand what she meant. Like,
no. And some people have to educate them every single time you call.
Every single time.
Miss, is you the one who called me the last time? I want you to know I don't understand what the last one said. Anyway, tell me again. So depending on your customer, That's what we mean by managing debtors. Sometimes it's a very straightforward
They're
process.
the people with the $100 credit card limit. Eh?
No, they have big time limit too. They just don't understand what the hell's going on. They don't care. And so you're charged with the responsibility of having to what? Educate them over and over again, depending on who they are. That's why some people in collections, for example, they become frustrated. Damn it! Then they start calling the customer names in their mind. And some people actually call the customers names in their faces, which you cannot do. You cannot. I don't care how you feel. That managing that is meant to manage them professionally every time. And you can't act like they're an interruption to your day, because the only reason why you're there is to serve them, even in their ignorance, over.
I heard a loan
Until
officer.
they finally get it.
I heard a loan officer ask the customer, "You can't understand."
Yes, they get frustrated because sometimes it becomes frustrating for lenders.
And you know, sometimes how our people go, they just don't understand, no matter how you break
No.
it down, they just don't get it.
No, and some of us can't really break it down.
No.
We think we're breaking it down. Miss, let me say it another way. Instead of supercalifragilisticexpialidocious, I'll say espialidocious. Understand? They say no. So we trying to break it down. We're not breaking it down well either, for the satisfaction of that particular customer. So it's a very dynamic job, actually. Okay, very challenging job. It is not a fly by night, and it's not a job that you give to any Tom, Dick, Mary, or Sue. Even though some people think so. Because here's what we say: any fool could lend money and collect it. But that's not true. Any fool cannot. My. All right. So these are the types of loans. Is there any loan on this list that you are not familiar with? Anyone?
The business loans, and the payday loans.
Okay. Well, a business or corporate loan is when a company comes in to borrow money as opposed to a person. So if Kelly's running out of money for some reason, God forbid, not likely. But a company like Kelly's or a small business company, somewhere like a bakery or any type of shoe store, whatever the company is, if they go in to borrow money, that is called a business or corporate loan. Okay. Payday loans, on the other hand, do you have any of those in the Bahamas? Payday loans?
Yeah, we have a lot of those. That is
Yeah,
so
these
popular.
days.
That's a
Can
popular.
somebody explain what a payday loan is for us?
That's like getting an advance on your pay. You go there. Well, I assume you go there. You give them your pay slip. Blah blah blah. Just like you would do a loan, and you get your money. Come payday, they expect their money.
Yeah, what they do is they give you it might be
Yeah.
probably more likely by salary deduction if they could get one. Those that they cannot get a salary deduction from, they may be a little more skeptical about giving them a payday loan. But depending on their level of risk, you follow, and the type of job you have, and whether they can call to harass you if you don't pay. Say things like that, they might say, fine, you're not a government worker, but you work for this or that bank, and therefore I'll take a risk with you. Because if you don't pay us, we'll come on to you. Not really. Yeah, something like that. So they'll still give it to you.
They'll get paid before the bank. Because
Yeah.
they're regulated.
So these are short term. You have to pay it back at the end of the month, the end of the following month, that kind of thing. You pay it back in 2 installments in full, whatever the conditions are of the payday lending company. So that's an example of a payday loan. Because some people live from paycheck to paycheck, and therefore, if something untoward happens, they need to find $500. That's like a freaking nightmare. So they need to go and get a payday loan, a short-term loan to cover that visit to doctor's hospital because somebody got sick unexpectedly and they had to find the money for the deposit, or the engine went down on the vehicle and the people down there will be streets $550. You say, mother's sick. I don't even know $50, $550. I need my car. See, like that. So you go for a payday loan. Right? Some people think payday loans are just to go to Florida and bring COVID back to Nassau and Grand Bahama.
I agree with you.
Sure. Okay. So there you have it. Okay. Most of the other types of loans are pretty self-explanatory. Thank you for raising those two because they tend to be the two that a lot of people are not familiar with. All right. Most of us are familiar with the other ones for sure, like student loans, debt consolidation loan. We know about the mortgages, car loans. We know about them. Okay. And if anybody in this session still doesn't know about any one of them other than what was just explained, please raise the point. All right. The personal loans, by their very nature, are personal loans. They're what we call what? Consumer loans. So personal loans are for personal items like vacations and education and medical and
well, anything you
auto loans and incident. Well, be careful, the incident get tricky, but yeah, if you explain your incidental. Yeah, license, maybe licensing, probably not. Payday loans for licensing. But personal loans are consumer loans like $3,000, $5,000, $10,000, $20,000 for things like that.
Oh, you in a different world, so you in a different world. You in a different world. Like personal loans are not $80,000, $90,000. Get it right.
Yes, they are, depending
Don't look
on
at me like that.
the situation.
Don't look at
Remember,
me. They Commonwealth, right? Commonwealth. You start out at Commonwealth Bank at 20,000. You top up at Fidelity with another 20, so now you are 40. You go back to Commonwealth Bank, you top up again, now you are 60,000. You come back to Fidelity, you are 80,000.
Unsecured.
yeah, that's another kind of nightmare.
Salary
completely.
reduction.
Remember, the academic side talks about reality, the academics, the non-real, what it should be. What she's talking about is what it actually is, and that monster that continues to drown so many people. Okay, but what makes a loan personal? Not the amount, but rather what? The purpose. Exactly. So you can get a personal loan for $150,000 if somebody's financing a Bentley for you. As long as you have the down payment insurance and you can afford the monthly payments, that's a personal loan. Okay? A mortgage loan is a long-term loan secured by real estate. Okay? So the loan type is determined by the purpose of the loan. Okay? By all means. For example, debt consolidation, we call it debt consolidation, but it's a personal loan. But it doesn't have to be a personal loan because debt consolidation is also done for corporations. See? So it's all about the purpose. So somebody says, I would like to marry you, find out why. And if they're like, yeah, purpose is very important. And they're like, why you want to know why? That's like going in to borrow money from the bank. They're like, what do you need the money for? This you, why you need to know.
Everybody want to buy you so they can stop waking.
I'm just making a point. The purpose has everything and a whole lot of things to do with the final outcome, the type of facility, how much we'll lend, what conditions we lend it under. Okay, purpose, very important. All right, so that personal loan is a loan for your personal use, as opposed to a business loan, as opposed to a mortgage loan. Okay, so to speak. There's a little discussion, you go in to get the loan application, it's for question.
A chattel loan.
Mm-hmm. Anybody knows what a chattel loan is? What a chattel is? Not mortgage.
Vehicles. It's usually done
yeah.
on vehicles.
Any asset that is movable, like a car, generally a car and furniture, those are chattels. They can actually be moved. Mortgage is not in that group because mortgages, you can't move it. All right. In the old days, they had some houses you can move. You do have any of those still? Even though
you have them in other countries, but not
yeah. So a chattel is a movable asset like a car or furniture. Okay. So if you're doing a chattel loan, chances are that particular loan would be a personal loan secured by a vehicle or furniture or some such thing. If it's a business loan, it may be secured by the what? Goods and services within the inventory of the firm or the business, whatever that inventory might be. Okay. So if you're a car rental company, you go to borrow $1 billion, then they may say we need to hold as chattel all the vehicles that you have available for rental. Well, of course, the lender is going to lend you according to the value of those cars and the level of cars and the level of depreciation. Any good lender, of course, by all means. They're not just going to just lay it out on you. Doesn't work that way. That's what we mean by the credit analysis. It takes into account all of those things. Okay? So lending is a big, big deal if it's being done properly and professionally. And it takes years of practice and experience to become a good lender in any category, whether it's business, consumer, or mortgage. Okay? It takes a whole lot of skill over time. All right. Interest rates, there's a little discussion. We know what the rates are in the Bahamas. Consumer loans can go up to what? Up to 15, 16%. We know credit card rates on the revolving credit card loans can go up to 18%, and in some cases, maybe more. The effective rate might be even a little higher than 18%, but it tends to swirl around 18%, which is very high. Maintaining a credit card is very expensive. That's why you are encouraged to pay off your credit card as quickly as you can, so that it doesn't drown you in debt. Because if you let it get too close to the maximum limit and you're only paying the minimum, what's going to happen is when you pay $100, $60 might go to interest and charges, and only $40 will go to your principal. So it's hardly moving. All right. If you miss a month, worse. 100% plus goes to interest. And so when you make that next payment, all goes to interest, and nothing goes to principal until the next payment. And again, it could become a living nightmare, as many people have found out. Okay. So again, interest rates are based on what? The level of risk. If you're a low risk customer, you get that lower interest rate. If you're a higher risk customer, you get that higher interest rate to accommodate and pay the bank back for the risk they're taking. What is the risk to the bank or lender?
That they won't get their
Yeah, that you won't pay the
back.
loan. I don't want you to think that because people come in smiling, snatched up or whatever, that they're going to always be paying you. It doesn't work that way. Everybody starts off great. First payment on time, second payment, third payment a day late, fourth payment a month late, and then depending on the customer, they stop paying completely for whatever reason. So it's a big risk to lenders to put depositors' money out there. That's why we're in here talking about this stuff, because your job is to try and give facilities that can protect depositors' money, and if you're a borrower, to understand how you should repay. So again, you may not be a lender today, but you are a borrower or potential lender. So this information is always good to know, no matter what capacity you are in. Another interesting point. Who knows the difference between a bank loan and a bank guarantee? Are they the same?
No.
That's a nice test question.
No, they're not the same.
Say true or false. A bank loan and a bank guarantee are the same, true or false? See that?
False.
I hope you do that next week. I'm just giving you a little idea of how these things can come. Or I might say differentiate between a bank loan and bank guarantee. And so you tell me what one is and what the other is. What is the guarantee?
The bank guarantee, they guarantee that if, give you an example like the book here, construction, they guarantee the company that the construction is going to work for, that if an event that the construction company is unable to complete the job, they will give them the money.
In other words, whoever guarantees the loan will have to pay if the principal doesn't pay.
Yeah.
Whether it's a construction company,
Or
a
the
father,
government.
mother, individual, wife, husband, doesn't matter. Anybody who guarantees a loan must know that if the principal borrower does not pay that loan for any reason, they're coming after you. That's what a guarantee is, okay? A bank loan, of course, is a loan itself, issuing credit to whoever comes to borrow. The guarantee is somebody saying, by signing their signature, that I will pay this if the main borrower does not pay. So whoever comes to you to have the guarantee, a loan, you better know what you're doing. That's my sister. That's okay, that's your sister. Just know that if your sister stops paying for any reason, they're coming after you. That's as simple as that. Any company that guarantees anything, If the principal borrower does not pay, they're coming after the company that guarantees, the same principle. Okay? By all means. That's why when husband and wives, for example, get loans, if the husband dies, they come to the wife or vice versa. The husband or wife stops paying, whoever, once the payments stop, they come to both. If one cannot be found, they go to the other. That's how it works. Especially in partnerships like that, where there are two signatures. I tell them, don't get this stinking house like that. Doesn't matter. They're gonna still come after who's left, who's available, who can be found. That's why sometimes when people want to get away from commitment, they disappear and leave the responsibility with the other person, whether you like it or. I don't need to say anything about credit cards. I already talked about them and the high rate of interest that's applicable. Just have a good read. Remember, these rates are US type rates, but they're very similar to ours because we're using what? Other people's rates anyway, aren't we? We're using other people's credit bureau thing too, potentially, and other people's credit score, maybe even other people. We all kind of OPP. Remember that song? I'm doing OPP. Anybody remembers OPP song?
Yes,
Yeah.
remember.
Other people's property. Somebody laughed as if they understood something else about OPP. Because OPP in those days had nothing to do with credit. You know that. Anybody know what OPP meant?
And what days?
Back in the day when the OPP came out. Yeah, I'm doing OPP and yeah, like that. Anybody remembers what OPP meant? No?
Other people's
property.
Yeah, what did they mean back then?
They mean other people's property. Other people things.
Yeah. Like what, for example?
Other people, man. Other people,
yeah, like.
Yep.
Yeah, thank you very much. Who said that?
Yeah. Sorry, Bethel.
Oh, yeah, Miss Bethel. Thank you very much for that. Yeah, like other people's property, other people's girl, other people. Yes, indeed. All right. The revolving debt, of course, we talked about that. That's the credit card. Doesn't have to be a credit card. You can have a revolving loan as well, where you have a line of credit and you can use as much of the money up to whatever that limit is on the loan. When you get there, you have to start making payments until you reduce it, and then whatever is left in between, you can use up to that amount. So, for example, if you go into the bank as a company or an individual and say, look, I want a line of credit for $50,000. You can use, if you use up to 40,000, how much do you have available to use? 10. See? So it's revolving. And then if you get a big time check from some job you did and you deposit, and clear it off, clear the whole crap off, like the whole, what, 40? Then yeah, now you have 50 to use again. See? So that's what we mean by revolving. Okay? Coming from the revolving door. Do we still have revolving doors? Like you walk in the door,
Not in the Bahamas, but they still exist.
They still exist. Okay. Bahamas revolving door? Yeah. Okay. Yeah, cool. Home equity loans simply means what? Borrowing using your home as?
Equity.
Using the equity in your home as collateral. The equity in your home as collateral. Now, a lot of people don't understand what equity is, just like we try and explain that credit card to Miss Rose.
The part of the home that you own.
Yeah, the part that you own. Equity is the part that you own. So if you buy a new house for 200,000, and your loan is 210,000, how much you own?
10,000.
Nothing. You don't own anything yet. Because you borrowed this extra 10 for medical, but the value of the house is only 200,000. Yes, you don't have any equity. Now as the years pass, you're paying it every month. This stupid mortgage. I should have phoned my money, whatever. But you're paying it. So now you pay 50,000 on the $200,000 loan. See? Now you have equity of how much?
40,000.
Well, 60. Well, let's move this. I just threw that in to mess it up a little bit. So you paid 50,000 on the loan, so your loan balance is now what? In principle, 150 theoretically. I'm not accounting for interest payment and all that crap that's gonna mess that up. I'm not going there. Theoretically, your loan balance is 150. The value of your home is 200. So now you have equity of 50,000. So if you catch COVID now, you can go borrow 10,000 against your equity. That's what an equity loan is.
You can't take it back up to the 200.
Yes,
Sure you can. Of course, you can borrow up to
50,000.
Yeah, I just threw that in so you don't do that. Don't borrow all because you could.
So if go back to the 200,000 and your house was, you had an appraisal and the value is now 220,000.
Oh yeah, now that the house gone up in value, then you're greater what? Equity. Everybody get that? By all means. So for example, 3 years later, for some reason, the value of the house goes from 200 to 210,000, and you haven't borrowed anything yet. So now your equity goes from 50,000 to 60,000. That's the beauty of equity. So getting a mortgage is a nightmare. It's a big time responsibility, but it's also one of the biggest investments the average human being will make. Even rich people understand that. That's why they like to buy a bunch of houses in different places for tax reasons and for equity reasons. So if they have a cash flow problem, some crap goes down, or they want to make a profit on something, they'll sell one for much more than they
bought it for.
Of course. Because there's always a, I don't want to say a fool. There's always a buyer seeking to acquire. Let me put it that way. That's the professional way of putting it. An investment. The other way? There's always some fool to outsmart. How's that? So if you're a buyer, beware. I'm not saying you're not getting a good deal. Just don't let anybody pull like something incredulous on you, which people do all the time, especially if you don't have information and knowledge about how things work. Okay? All right. So you see, credit collection is not just about the academic side like this for tests. No, this crap is very alive, in case you haven't figured that out yet. And whether you're a lender or borrower today, this stuff is still very alive. This is relevant to all of us and you know. And if it isn't yet, I guarantee you it will be. So when you start feeling like, why didn't we do this class? I could have been home cool enough, ducking COVID and all that. But I can assure you that by the time this crop is over, you'll have more stuff under your belt. See? Belt. That will become handy and useful sooner or, yeah, if not, rather than. All right. Anybody read the low risk, big risk? Anybody read that? This is how we find out who's read ahead. Low rates, big risks. What was that discussion about? Anyone? Online group included. What is that discussion about? Low rates, big risk. What did they say in a nutshell? Because that's how I want you to study too. Read it first and then take the whole crap and put it in a what? Nutshell. Oh, I'm gonna read that now. Now, let me tell you guys a little secret. Tonight is Wednesday. If you haven't read all the credit notes yet, which you should have read last weekend, just read, not study, just read. Big difference, they're not the same. Between now and Friday or Saturday morning sometime, make sure you've at least read all the notes. So that come Saturday afternoon, all day Sunday, don't go to church is closed. Don't all that.
Church is closed.
Or don't go on Sunday.
No,
I know. Don't try it. Absolutely. Point well. No, my heart goes out to Kaisha because she's gonna have a greater challenge than some of you know. Okay, because children, what ages are your children, Kaisha?
17 to 9.
What is
So
it?
17, 15. She gonna be 16. 17, 15, 14, 13, 11, and
Oh my God. And sometimes they could be worse than 7, 6, 5, 4, 3, 2. Because at least when they sit there, blah, but some of the bigger ones they have all kind of crap going on sometimes. So it could still be a challenge. And that, but give it your best shot.
so I have to go to church.
Don't stay long. 1 hour and go home. How's that? At least you show your face. And then all day Sunday, you guys just study, read, study, practice, because see, come Monday again, egg again. So don't wait until Monday. Use this weekend to do all your hardcore study and remembering. All the more reason you need to be at it.
Out of church.
Period. Just go and do like this. Maybe sign it, hail the bishop or whatever, and head out. Because once you do that, nobody can say you wasn't what.
Yeah.
Of course. Hello, baby thing. I was there. You're gonna talk to super again and you see me. I was there. Thank God. And then, all right. So low rates, big risk. We know already that the lower the bank rate is, the less the risk they consider you to be to the lender, whoever the lender might be, credit union, bank, financial, whatever it might be. Okay. The more of a risk you tend to pose to the financial institution, the more they're going to charge you to cover their risk. Okay. That's one of the reasons why mortgage rates tend to be somewhere between 5 and 8% and all that kind of stuff over long term. And at the end of the 20 or 30-year mortgage, you find sometimes that the amount of interest you pay is more than the amount you borrowed. And the reason for that is because of how long into the future the mortgage goes. And the financial institution always expects to be compensated for taking that risk. Sometimes it's an excuse that the rate doesn't have to be as high as it is. However, if you want your own house and thing to develop what?
Equity.
Then you have to bite the bullet and suffer the consequences. So it's a trade-off. Okay. Most of us in our lifetime, our biggest investment will be in our home, especially working class people, not non-celebrities, people who inherit billions like the Simonets and the Wilsons and thing now. But most of us, our biggest investment will be our home. And so we can expect to be caught up in that interest rate dilemma, to pay a great deal of interest over a long 20, 30-year mortgage and all that stuff. So that at the end of the day, we have something that we can call our own, or you don't have to stay in it until you die. You can do what? Sell it. Remember, a home is an investment. As you get older, like for example, now, I was walking around this damn house I bought back in the
Why?
like,
This old big old house.
but as my
big old
yeah,
house?
but because of my babies, this me, I'm gonna set an example.
Yeah.
No, they definitely does go. Cause
Yeah, but then when they growing up, you want.
no, you no
for
do
them
that
to have
crap.
a separate,
No, don't yeah,
place.
no, do that crap to the extent you could do it. I'm not saying don't do it. I'm just telling you that like you don't have to necessarily stay in the house until you die. You may want to and then pass it on and try and fight over it and all that. That's one option. That's one of the good things about equity and mortgage and all that. It's an investment for one reason or another. Okay? But I was looking at the steps just now and I saw my baby. Before I put the rail on the steps a million years ago, he was on the edge walking up, coming to us upstairs like this.
Oh,
And I'm like,
my
what the flick? Because if he had gone that way, what would have happened?
goodness. He'd have fought.
And maybe,
God.
yes. And I'm like, because you know, when you first move and if you don't have like a bunch of money, like do little stuff here. So the rail wasn't there yet. They don't come up the steps. But he was the adventurous one. The older one, never. But this dude, he's 5. He was like always adventurous. Like, I'm like,
And he
what the
walk
hell?
on the inside,
No, he was
walk on the
smart. He
outside.
got, he was by the wall. He ain't stupid.
Oh, okay.
Like that. No, he ain't going up like this. No, he gone up by the wall like this. When I saw him, like, what the hell is my baby doing up there? He said, hi, Daddy. I was like, what the flip? After that, man, I begged, stole, and borrowed. But that real? But I look at the reel the other day. That's the one who's in Canada now, my baby. And I saw the baby was going, now he's a man. And I'm like, what the flick? I saw no need this crap. This me walking. I'm like, what the? I'm like, any of you guys coming home? No answer. One in New York, one in Canada. They look like we won't stay. I said, let me tell you guys something. You have 2 or 3 more years to decide if you coming to mess with this. Otherwise, don't. I didn't say it like that. I'm just saying that for drama, to make the point that you don't have to die in the home. You can either die in it and leave it for whoever to fight over, or you can do what? Sell it and use the money to what? Cool out in your old age rather than maintaining house with children gone. See, like that. Now, if they want to come and take it over and all that stuff, then you and your wife, or husband, or whatever, wife, go in the room and cool out and they'll try to fix stuff. But if nobody's there, because they're around the world doing whatever they do, then sell it. Take the money, put it in a thing, rent a little condo for like a couple $100, and then like kick back, like where are we going next? Yeah, like, yeah, this is great. So it is a good thing for one reason or another. Okay. So don't let them scare you with, oh, you're gonna do it, because it's probably the biggest investment you're ever gonna make.
But people like say a home is a dead investment.
No, it's not.
Well,
Don't let anybody tell you that.
I am my house, right? I pay in my mortgage, you pay in rent.
Don't let anybody tell you that.
You don't pay your rent.
You're gone. When you don't pay your
At least I
mortgage, you're gone
get,
too. But
yeah, but at least I get equity. At
yes.
least I get equity.
Not only do you have equity, you could sell it. You can't sell the landlord's house, but you can sure as hell sell it to a fool like him, who will pay more than you pay, because that's the house of his dreams. It's like seeing the girl of your dreams. Like, let's take this, the chick I was always looking for. And you're like, oh man, everybody, what do you see? Like, don't worry what I see. It's like that. Homes and it's like that. Okay? For sure. So don't anybody tell you that stuff. When it's time to do it, if you can. It's always a good idea, because you have a lot of options at the end of the day. If you find that you can't afford it anymore, sell it. If you can't make the payments anymore, sell it. If it gets to be too big or too quiet or too lonesome, of course. If your children ain't want it no more because they have their own thing now, of course. But in the meantime, you could borrow against it, roll over in it, say it's yours, whatever. Like that. That's the point. All right. So yeah, it's a big risk. Pay a lot of interest and all that stuff, but there are some other significant benefits. That's why we still do it. And that's where the home equity lines of credit come in. You can use your equity to get a line of credit to have available. You don't have to use it just for the hell of it. Get it, have it in place for 3 years, 5 years, whatever period of time they give it. In case you have a medical emergency, you have a child who's going to college soon, whatever the reason, you can use your home equity line, the equity in your home again, so that you have that line available if you need it, not to waste it. See? Like, I have a line of credit for 30. Oh, that's sick. I go to Israel. Yeah, like my friend going to Israel next week after COVID. Yeah, like just because it's there. That may not be a good idea. Okay? But for other important things in your life, it's a good thing to have. All right? The other thing you need to know as a lender borrower is this: fixed rates of interest versus variable. Who knows the difference? Yeah, fixed rate doesn't change. Variable rates change.
Yeah, like prime.
Yes.
We stuck to prime rate.
Well, for us, we only have a change when something happens with prime. In the US, any crack could cause their rates to change. That's why the housing market is, in other countries, always up and down. Because if something happens in the investment market, period, not prime, just in the market, rates can go up, which means your payments go up. And then if something else happens, rates can go down, then your payments go down.
Like how it is now.
Yeah.
Wonderful.
Yeah. So depending on which direction rates are going, dog will be eating your lunch, you'll be eating or you will be eating the dog's lunch. That's how it is. So be prepared, especially if you're a lender outside of a country like the Bahamas, for these fluctuations. At least our rates tend to be pretty permanent unless something happens with prime. And our prime doesn't change too often. Thank God. which we don't have any appreciation for because we keep complaining.
Yeah, no, we don't understand.
No, we don't understand a lot. Or we just keep flicking, complaining everything. Every time you fix something for Bahamian, we have a gripe. Yeah, I see that fix, but what about this? And we do that across the board with a whole lot of stuff. God help you with the stuff we don't even understand at all. And there are a lot of things we really don't understand at all. All we understand is the little things that are happening in our little circle, like this. In my yard, my car. That's it. You don't hear nothing about all the other intricacies out there. All right. But in a nutshell, we are very fortunate people. Let me just put it like that for the moment. Maybe you'll figure some of that out eventually. All right. Cash advances. Anybody who's not familiar with a cash advance? What is a cash advance? Yeah, you could use your credit card and get money, but just know that that money is going to be added to your credit card balance along with the 18% interest charge. Plus, there's a fee for cash advances.
Yeah.
Yeah, and nowadays plus VAT plus thingam.
And that,
So there are a lot of, yeah, all the charges you can get the 300 you need. They'll let you use your card to do it, but just know that you're going to come under fee fire. You'll have to pay. There's a price. There are fees and fees and fees for that. That's why you don't get cash advances just for the hell of it. You get things like cash advances when you need it, when you have an emergency. Supposed to be, but we've turned it into a card of convenience and a card of desire. I desire, not need anymore. Man, you don't need that. What need have to do with it, man, Susan? I want it, and I don't wait. I want it now. Payday 2 weeks from now. I can't wait. And then I asked that Johnny cheap, like I want it now. Something like that. Small business loans, pretty straightforward. It's just a loan to small businesses. It's a company loan generally, but not all small businesses are company. They are what? Sole proprietors. So you might have a small business that is not a company, that's not been incorporated. If it's not incorporated, it may be a small business, but it's not a company loan. If it's just a sole proprietorship without being a company, it's a small kind of personal loan, even though it's a company. We have a lot of companies that operate as sole proprietors. When they go into borrow, the borrowers borrow in their name, not a company name. Okay? And they cannot borrow in a company name until they incorporate the company legally. Until then, they have to borrow in their own name. And if something goes wrong and they don't pay, the lender can come after the company and their personal assets. If you're a company, they can only come after your company assets and not your personal assets.
So incorporated.
If necessary, because some are too small to incorporate, because incorporations can be a little expensive every year for a small business and unnecessary because of the type and size. But once you start to grow a little bit and things start to get a little, cool, and you start making money and the risk is getting greater, you need to borrow and all that stuff. Yes, incorporation is a good thing, especially if you have to start borrowing what? Significant amounts of money, because you don't want your personal name to be on a loan with significant amounts of money for the company. The company takes a dive, and then the lender comes after your personal assets, your home, your car, your whatever they can take that somebody else doesn't already, or possession over by means of another loan. Okay. Absolutely, small business loan. All right. The other thing I want to ask you guys is on the next page. Some people think that an overdraft and a loan are the same. Are they?
No.
Yes or no?
No.
Is an overdraft a loan?
No.
Yes. But no. But an overdraft is a loan, but it's not a bank loan. Here's what happens. It is, but a line of credit is a kind of loan. It's just that when we say bank loan, what we mean is what we call a fixed
This is-
term loan. Fixed term loan, see? Where you go in for a car loan, it's for 5 years, the payment is $500 a month, and the interest rate is 12%.
Mhm.
That's a fixed loan that will stay fixed for the entire life of the loan. An overdraft, on the other hand, is a little different. An overdraft says, we'll give you an overdraft limit of $3,000. That
Mhm.
means that once you've used up all the money in your checking account,
Mhm.
if you need more
You
money,
can continue to
you
use
we'll allow you to write checks up to
up to
$3,000
$3,000.
and over the balance in your account up to this amount.
3,000.
That's what an overdraft.
$3,000.
Okay, absolutely. Okay, and then of course, if you take it up to 3,000 too quickly, then you stop. You can't write any more checks until you start making deposits to bring the 3,000 down
Down.
to what? Zero,
$0.
and then plus
Yeah.
dollars. That's how an overdraft works, in case you didn't know. And that's how it's different from the fixed loan. This is more of a revolving loan, see? Because of this. How you deposit money goes up and down. So if you take it up to the max, like, like, oh, thank God I'm free. I couldn't travel for 3 months. So you write a check for 3,000 right up to your overdraft limit to go to Florida to shop. Then you're stuck. If your engine goes down when you come back, you don't have any source of money because you're already at your limit. You have to start making what? Deposits to bring this down.
Mhm.
So you got lucky, somebody owes you 500, brings it. So you're, thank you, Jesus. So now your balance is what? 2,500. So now you have how much available? 500. Absolutely. That's how overdrafts work. Okay. And then if somebody gives you a check, let's say this is 2,500, and somebody gives you a check, God forbid, for 3,000, now you can pay off what? The entire overdraft and have a credit balance of $500. That's how it works, in case you didn't know. Okay. So this thing called credit and collections, remember I told you, doesn't matter if you're a lender yet. Doesn't matter if you're a borrower yet. It's still relevant. If it isn't, it will become sooner or later. That's the beauty of doing this stuff. So when you step out in a couple of weeks after this crap is done, not crap, you know what I mean? Trust me, you'll be a little more enlightened, hopefully. Not only for the job you may be doing in this area, but also for your own personal benefit. That's the other significant thing. Now, notice in this little discussion about bank loans versus overdrafts. There's an example of the loan. Anybody worked out the example?
I did.
Did it work out?
No.
What happened?
No.
By a lot
I got
or a little?
$383. Some cents.
Okay. If it's any consolation, I will not ask you to do any calculations for this semester. But those of you who do part 2, we will do a lot more calculations on how to determine loan payments, how interest payments are worked, and those kinds of things. All right. So have a look at it if you may, but I will not be asking you to do any calculations. I might say what are 1 or 2 advantages and disadvantages of a bank loan like that's here. I might ask you that. That's a pretty straightforward question. And then you just respond. Remember, your answer doesn't have to be verbatim, word for word, as long as the answer makes sense at the end of the day. All right. So we have the advantages of the overdraft and loan, and then we have the disadvantages. What is an advantage of an overdraft? Flexibility. Now you may not remember the rest of it in the test. So if you remember flexibility, throw that in. Don't say, what is the flexibility, but I can't remember the rest, so I'm not answering. Don't do that. Try to remember all of it to the greatest possible extent. But if you only remember flexibility, then flexibility. Write it down. And then let me figure it out. You will get credit if you say flexibility, because that's the core answer. The rest is just what? Detail. Okay? What is an advantage of a loan?
You can borrow larger.
Absolutely. Absolutely. And the same thing for disadvantages. So I could easily say, name one advantage and one disadvantage of a loan and overdraft, and then it's a piece of cake. But if you don't look at it at all, then you won't be able to answer, just stare at it and say, I should have studied that. Don't try to figure out what pages to study. Just cover up. Yes, and you'll be fine. All right. So, having said that, I think I've talked enough so far. Who was my last reader anyway the last time? Who said me? Guys. Was it somebody on online group?
Jamaica, I think. Jamaica.
Oh, Jamaica? Yeah, what the hell is Jamaica anyway?
Yeah, you know how to discuss.
Oh, yeah. I don't remember everything. I leave that to you guys, because I remember when I used to remember everything, every detail. What's phone numbers that I don't need, all kinds of stuff I don't need just because for the hell of it. I don't do that anymore much. All right, yeah. So Dominica read. So that means who's Alkeisha? Who? Oh, you read as well. Yes. Doggone it. Who did not read? Hey, Kaisha, I'm going to start from the bottom up this time. Why don't you kick in and do your thing, beginning with loan structuring?
Or longer terms, depending on the clients and goals. You can hear me?
Can you guys hear Kaisha?
Yeah, we can hear her.
Perfect. Okay, keep going.
Because we have to remember the goal of the loan is to secure property. So a loan product that, sorry?
Go ahead.
Yeah, keep going.
One, that product is really a short-term means to a bigger end goal dream. Loan structuring encompasses two main areas.
Yes.
Product selection. When you choose a mortgage, you need to factor in different things in your decision-making process. And as with any advice we provide our clients, there is not a set classroom. We use one loan product to suit every loan structuring scenario. So when you are choosing a lender and loan type, you need to understand the true potential features of the loan product on offer.
Number two?
Two, the loan itself. How is the loan going to split, if at all? What securities are going to be provided as collateral to the lender for this loan? Is it going to have an accommodating offset account, redraw facilities? Do you make principal and interest repayments or interest only, etc.?
Now notice what is interesting. Stick a pin for just 1 second. Can you? All of a sudden we're looking at this stuff through whose eyes for a moment? The borrower. But of course, if we flip the switch, we can easily see the lender saying the same thing. What am I going to take for collateral? What am I seeing? So it's just two sides of the same coin. The point is the considerations that you have to take into account when we're looking at structuring a loan, whether you're a borrower or a lender. Okay, keep going.
Loan structuring is about tailoring the needs of the clients with sound advice. The problem with most people seeking a loan is they treat it like a transactional thing, buying a mortgage product. The frustrating thing with this one is those people are missing out on receiving really valuable advice that has the potential to save them thousands or even $10,000s of dollars.
And this comes into place you were saying earlier, like trying to educate the customer about what's going on. Sometimes the customer don't want to hear it, they don't understand it, the loan officer don't want to waste time talking about it, they just want to get the loan book and go home or something. Okay, so oftentimes these facilities and structuring are happening and people are missing out on valuable information on how this thing is good for the goose and the gander. All right, keep going.
most customers don't know what to ask of their loan structuring options, and or they deal directly with one bank instead of using a mortgage broker.
Who's a mortgage broker? Anyone?
Someone who looks at more than a few companies.
Yeah, a
to get
middle,
the
yeah,
plan.
a broker
Yeah.
is what? A
The
middleman, okay? Who says, hey, don't just go to that bank. Let's consider a few and compare rates and compare conditions, compare whether this is good for you or not, and then choose the one that you feel is best for your condition. Don't just marry the first person.
Will we learn about brokering in this course? Excuse me.
Brokering is part of credit collections too. Okay, so if you're interested in that, you'll see quite a bit about mortgage brokering in part 2. Who said that anyway?
Okay. It's Truman Cooper.
Good, Mr. Cooper. Were you here last week?
No, sir.
Okay, fantastic. I'm glad you spoke up. That means that we have a grand total of 2 guys in this class now. Okay, what's your first name, Mr. Cooper?
Truman.
You mean like Harry Truman?
Yes, sir.
Good. You are walking around with greatness. Truman.
I claim it.
Amen.
Where do you work, Truman?
I work with Alive at this time.
Wonderful. Okay. Now, that means you don't have my email address and all that stuff.
No, I don't believe that I do.
Okay, what to do, let me give you my email address, Truman, and then you can just send me an email so that I can know how I can reach you, blah, blah, blah. Okay?
Yes,
my
sir.
email address is S, as in Samuel, J as in Jack, H as in Henry, Wilkinson, WILKINSON @hotmail.com.
Okay.
Welcome aboard, Mr. Cooper. Are you aware of the examination details, blah, blah, blah? Has anybody filled you in?
I am vaguely aware. I would have reviewed the videos from the first 2 classes. I believe that there's an exam schedule there's a midterm schedule for week 3 and an exam schedule for week 5.
That's close enough. Actually, the midterm is next week, Wednesday.
Right.
And it will be based on everything from the beginning of the lecture up to the end of the credit section.
Okay.
You will not be tested on the collection side of it at all.
Okay.
Okay, so make a note of that. If you have any questions along the way, feel free to, well, of course, you have that email. Let me give you my phone number as well, so you can send me a text if you want to.
WhatsApp is fine?
Yep, that's fine. 565 9551.
All right, thank you.
Wonderful. Well, now that you've joined us, maybe you can introduce yourself to these lovely ladies and your other colleague, Mr. Glenton. Please introduce yourself. Tell us anything you feel like.
Okay, well, my name is Truman Cooper. I am very interested in the credit and collection course because it is a wealth of knowledge that is going to help to propel me to a business that I have started. I am interested in learning and I'm interested in networking. So
sounds good already. So you are definitely in the right place. If you're thinking about being an entrepreneur, anything you learn in credit and collections will be a benefit to you in one form or another. So welcome aboard, and that information that you have, pay close attention to it. I'm sure I don't need to say that at this stage of the game. If you want to really push your credit and collections information further, please sign up again for part 2. You mentioned something about brokerage. We'll be talking about brokerage, how to calculate loans, mortgages, how these details work. So it'll be quite an extension to what we're doing now. Okay.
Right.
So welcome aboard.
Thank you.
All right. So maybe I can take this opportunity to do my register before we go on. Hmm? Okay, Malik is here. Absolutely. Which week are we in anyway?
Third.
Absolutely, already. Remember when we just walked in the first week, like we stumbled in, like, what the hell? Now we're in the third week. Next week, having the test. Remember, the test is going to be for the first hour and a half of the class, and then the lecture is going to be for the next hour and a half. Do you want the exam first or the lecture first?
Exam first. I'm trying to remember everything.
Yeah, I know. That's probably better. Yeah, because you have a lecture first, forget everything, quote unquote. Which in the old days, we used to say, if you forget everything, you never
Do it.
But I get it. It's too stressful to listen to a lecture, waiting for an exam. I hate that. Okay? I had that a couple of times. That was a nightmare. So next week, when we come in at 6 o'clock, we'll do the exam first for the first hour and a half. And then the next hour and a half, we'll pick up on the collection side of our discussion and move forward. How about the exam? I know. Hell no. And I'll be totally ignorant about credit next week, unless you have a specific question. All right. Where's Rochelle? Right here. Doggone it. Domika is off fanning around. COVID bring us. We need to buy another mask for Domika. She come next week or whatever. Is she? Okay. Alkeisha, right over there. Annette.
Present. Hi.
Hi, Annette. Doggone it. I can't see them. I just see names. Ah, there she is. Yeah, everybody online is staring at me like, we can see you, but I can't see. When I look, I just see like names. Okay. Latoya.
Latoya.
Okay. Trotman. Who's Trotman? Oh, how do you pronounce your first name again, Miss C? Tanisha. Ah, yes. Tanisha. Kaisha.
All right, you're on board.
I can't promise you that next thing. I'll take my kudos right now because next week I might call that. God knows what I'll call that. All right. And then Truman is with us tonight. Okay, great. Now my online group. Janine.
Yes, sir.
Hey, there you are. Fantastic. Lori.
That's you, Laurie.
Right here.
Right over there in the darkness.
Yeah.
Okay. Tennessee. Tennessee?
She doesn't look like she's here.
Oh, Tennessee. That's me good. All right, Tennessee is off. Dealing with something critical, I hope. Gertie.
Hi, I'm here.
Hi. Well, there you are. Fantastic. Renita. There's Renita.
Hi.
I can actually see Renita. Doggone it. And I can see Tiffany. And Laurie. Perfect. I can finally see people. Okay, Renita is here. Tiffany, I see here with us. Tanisha. Yeah, Tanisha is with us now. Whose name did I call everybody's name? Fantastic. All right, moving right along. All right, keep going.
Using a mortgage broker who can present a number of loan structuring options across a range of lenders. They just become a volume or transactional sale for the lender, and that's it. The professional finance advisor should get on the front foot. What is the front foot?
Yeah, what is the front foot? Yeah, kind of like get to the forefront and say something that needs to be said. Yes.
Like you can't afford this home, you need to, you know?
Yeah, like, excuse me, miss, you realize that this loan you cannot afford. Oh, gee, why start crying? Like this is what I always wanted. And then you have to pull out the tissue, like, and then when she's finished, like, you know, but you still can't afford it. However, here's what you can afford. Stuff like that. Absolutely. All right, keep going.
And on the front foot, and at least explain to a consumer that there are options for them to consider and which will be part of an overall financial solution. Offering for these prospective clients, consumers will be willing to pay for this advice if they saw value in what was being said.
Yes.
Because you cannot erase the past, and it's a costly process down the track to undo poor loan structures and mistakes made in the past.
Absolutely. In other words, do the work up front now, because once you're structuring a loan, it's like building a house. If that structure is weak at the beginning, dog eat your lunch. One day when you're laying there, it's kind of like that. All right. So take the time and build a what? Strong foundation and the things that matter, so that you don't be in for too many surprises. The same thing with a loan structure. All right, keep going.
The subject of loan structuring should begin with two basic definitions: loan structuring and risk. Loan structuring is simply designing the loan to fulfill the financing requirements of the borrower while spontaneously.
Wow. I know it looks like spontaneously.
Simultaneously.
Yes.
Attempting to lend against loss resulting from the failure of the borrower to repay the debt and the interest or fees thereon.
Absolutely.
Risk can be defined as the perception of a potential adverse event occurring in the future.
By the way, has anybody in this class ever taken a risk?
Yeah,
Every day.
every day.
Every day?
Every single
Good.
day.
I just want to make sure that you guys don't act like I'm immune to risk. Nobody is. That's the point. Neither the lender nor the borrower, neither nobody, as we say in the old days. Okay? Keep going.
Perception is the key word in this definition.
Sorry, where are we reading from?
You're reading the benefits of good loan structuring at the bottom.
That's at the bottom of
Loan structuring.
loan structure.
No. Trying to find his place.
Do you see the bank loans and overdraft page?
No, sir.
Which page is that?
I'm not sure if I'm looking at the right.
Can you see my?
There you go. That's what to do.
Can you see the page I'm showing you?
Yes.
It's this page here. Over my
Loan
left hand
structure. Okay.
at the bottom.
Let me see if I can find that page.
Go back in and take that number to pay. Huh?
Exactly. They need to number it.
Doggone it.
Is that before or after credit approval process?
Before.
I see loan processing step-by-step procedures. I see equity.
The type of loans. That's where loan starts.
Yeah, let's go back like which pages if you count the page 1, 2, 3, 4, 5, 6, 7, 8, 9. Go to page, count 9 pages from the beginning.
Front and back, 1.
Yeah, front and back is 1, 9 pages. And then you'll see finance, bank loans, and overdrafts.
I see credit policy. I see types of credit. I'm looking at a electronic version, so ours may differ just a bit. But
Yeah, credit policy is.
Keep going.
Keep going.
Okay. Basic outline for developing a credit policy.
Keep going.
Keep going.
Okay. 2 or 3 pages down. Understanding different loan types.
Keep going.
Okay.
Yeah,
Revolving
keep going.
debt, how equity, lines of credit.
Keep going
or
until you
home
get to
equity.
loans and overdrafts.
Okay, loan structure and credit appliances, regulations. See
Where are you now?
the 5 C's of credit. Maybe I went too
Too
far.
far. 5 C's. Man,
Way
you really
past
on the road.
Way past it.
Go back
Okay,
5
loan
pages.
structuring.
You see it?
Yeah,
Yes,
we
sir.
had the board of benefits.
Fantastic. And then you go to the bottom where we have benefits of loan structuring.
Okay, great.
Yes.
Thank you.
All right. Way to go. You know, just flip like this. Okay, keep going.
When one such event occurs, there is no longer the risk of the event. There is then the reality of the event.
Okay, so we're on the next page at the top. Okay, keep going.
Loan structuring involves several elements, including purpose, amount, collateral, and type of loan, risk recognition, and
Mitigation. Yes.
pricing, and financial covenants.
Covenants meaning?
Agreement.
Agreements. Yes. Thank you. Keep going.
All of these elements must work for both the borrower and the lender within the 2 definitions above.
Okay, so that's a nice little question as well. Loan structure involves several elements. Name them all or name 3? She said 2. What happened to 1? And I said, man, what happened to none? That's the problem. Don't mess with how much. Just know and then write as many as you could, depending on. Two. All right, keep going. But notice these structuring elements are key. These are foundational. That's why we call them structural foundations. That's why we use the word structure. Purpose, remember? Amount, collateral, type, risk involved, pricing or cost of the loan, interest, and all the financial agreements attached there too. These are the fundamental structures that must be clear to both borrower and lender, and they must be in agreement with them. Otherwise, you're going to have a problem with that and any other loan you do, or that and any other loan you borrow, if you're a borrower. All right, keep going.
The borrowers will find the loan must satisfy its purpose. The borrower's requirements are fulfilled only if the loan enables him or her to accomplish their intended purpose. Obtaining working capital to meet payroll, pay rent, taxes, and vendors, buy new or repair existing equipment, acquire another company, expand markets, develop a new product line, etc. For different borrowers in different industries, in different circumstances, the loan that enables the borrower to accomplish any of these purposes may require different structuring.
Definitely.
Any improperly structured loan may prove to be a deterring rather than an enabling factor in the borrower's accomplishment of its purpose.
In other words, if you don't give the borrower the best deal as a lender, you may not only be hurting yourself as a lender, but hurting the borrower as well by giving them a less than desirable deal. Absolutely. Okay. When Trump signed the doggone thing the other day and said, look, we're going to shut down all this stuff we're doing with Hong Kong banks, Ching Heng Ling and company got pissed. Anybody knows why? Probably not. And somebody may say, yeah, that's stinking Trump again. The flicking messing with Ching Lang Ling, as if Ching Lang Ling is anybody's friend. Anyway, but just for information, since you're borrowers and lenders, Hong Kong was under whose control for 100 years?
England.
Which means that they lived in a democratic society for the last, what, 100 years? Which means that all their systems are based on Western systems, which means that they were in a democratic environment. Now that the Chinese have Hong Kong back, they've now passed laws. Say, anybody who talk negatively about us, we're going to lock you up. Like we do all our citizens.
No more protesting.
No, shut your trap, you stinking Hong Kong. We're in charge of you again, you bastards, and your bank. And we want your money, which you're in anyhow, and anybody else's money. So that's why Trump said, American money will not go there. We're gonna sanction anything American so that the Chinese do not benefit. Now that they've taken over and intimidated the free-wheeling Hong Kongians. Hold on, huh? They can't even leave now to flee the country. They say, we catch anyone trying to flee, we're gonna flick and break your legs. Bastard Hong Kongans. You don't know who in charge now. You're not under the Brits anymore. You're not free to move.
The Brits say they could come, but
they say, you bad, you bad.
You gotta get out the country first.
You bad, move.
They gotta get out the country first.
And when you sneak out, carry everyone you know. Because whoever you leave, you know.
That's so sad.
All of you who support. Lang, lang, lang. They're not even the friend of their own people. Why would they love us?
We know that.
I told you, Bahamians don't know a lot of things. All right, whoever's reading, keep reading. I just thought I'd throw that in for the record. Keep going.
You sure you get the item? The amount of the loan is critically important.
Sorry, yeah. I know. A tight is a typo. That should be right. And I'm thanking you for reading it so that it jumped out at you. Oh, God. So some she's a man, I'll go with tight. Yeah, just make a little thing there. That should be R. Right amount. Okay.
Critically important elements of good loan structuring. For the achievement of any of the borrower's purpose, the amount of the loan must be at least adequate, with a bit of wiggle room in some cases, perhaps.
Yeah, so you notice it's not black and white, it's not scientific, it's some combination of whatever is suitable for the particular deal that you are structuring at the time. Okay, it's not black and white because everybody's situation is different. Absolutely. It's like relationships. If you leave a doggone stinky spouse, you can't go in a new situation and I just want to try it. And so you walk in and say, not today. What the hell? But that's because you carry stuff, bro. Sweetheart, why you say, Lord, don't call me no sweetheart. Because then the other one never call him nothing. She's a dog. So we have to be careful. Loans are like that. You cannot use the same thing for everyone. Even though some lenders and some institutions try to do that. They try to maintain a black and white. And sometimes that's okay, but that's not going to always work. And even though it might appear to be working, a lot of times you're not only hurting yourself as a lender, but you're hurting your borrower as well. All right, so be careful if you're a lender. Okay, keep going.
But never accept it. Lending too little obviously jeopardizes the borrower's ability to accomplish its purpose, but may also endanger its ability to repay the loan because the purpose is not fulfilled.
Absolutely. So the lender says, I need 50,000, and you're like trying to cut them down because you're a little uncomfortable with that lender. We'll give you 33. You go, dude, I need 50. 33. So you give them less, and then they can't do what they wanted to do, and therefore they don't generate the returns, and now they can't pay you. And you have what? 33 outstanding. So you have to be careful. Okay? All right, keep going.
Lending too much could create a repayment problem for the borrower because cash flow may be inadequate.
Yes.
Consequently, the lender may assure itself that the borrower has or will have sufficient cash flow to service a loan for the correct amount.
Absolutely.
Collateral and the type of loan are important. Loans to government contractors are generally either revolving lines of credit and working capital support of term loans and
acquisitions.
Thank you. Acquisitions, expansions, or equipment purchases. Occasionally, a contractor will acquire real estate and require a mortgage loan, but that is a category of lending beyond the scope of this article.
Indeed, on this lecture. Okay,
Revolving lines of credit usually supplement short-term working capital. They are generally secured by current assets such as accounts receivable and sometimes inventory.
so revolving loans are very popular with businesses, because remember, they represent the overdraft, where you can either get an overdraft facility or a line of credit, and the lender will say, great, whoever owes you money as receivables, we hold that as collateral. Any money coming in, we use that for the loan to pay down the revolving credit, so you can continue to have money available when you need it to buy inventory from your suppliers and all this kind of stuff. So you see, and I kind of throw this in here so that you can see that lending is not only limited to the consumer loan to the customer to buy a car. It is also a big part of the buying and selling industry outside of financial services. Okay. Keep going.
Since these assets are volatile
Yes.
by nature, abetting the flowing with increasing and decreasing revenues, they shall be financed with short-term loans, 1 year or less. However, no periodic payout should be required because the continuing business generates continuing adequate to meet
Continuing.
assets
Mhm.
and need continuing support.
Yes.
Rates of loans advanced against these assets should be adequate to meet the borrower's needs and shall still provide an adequate cushion of protection for the lender against reasonable dilution in the collateral.
What do we mean by dilution? By dilution of collateral? Dilution means it reduces in strength. Yeah. So if you're holding accounts receivable and some of them go bad, you want to have a situation in place where whatever's left can still be sufficient to pay you for the loan that you, or the line of credit that you advance into your customers, such that everybody continues to be in a positive position. Okay, keep going.
The orderly conversation of these assets represent the primary source of repayment and should be sufficient. Term loans are probably made in finance generally. Non-recurring requirements.
Recurring.
Yeah, non-recurring. What does non-recurring mean?
It's steady, it's steady.
Yeah, it doesn't happen over and over. It's a one-time thing. Okay? Recurring means over and over. Non-recurring, one time. Okay.
Non-recurring means one time.
Yes.
So long duration and necessary.
Yeah, it's a bunch of stuff necessitating, yes.
Extended time for repayment. The activities are not of such nature as to generate cash for repayment within 1 year. Thus, the collateral is usually
tangible, yes.
Assets with current and projected value to secure the loan.
Indeed, and again, I'm not gonna bog you down with all of this part of the lending process in this examination. That will be part of your second part of this thing, where we get into a little bit more of the nitty-gritty about lending details. Okay. All right, keep going.
In structuring term loans, the lender should not only consider the value of the collateral, but must pay close attention to the adequacy of the historical and projected cash flow as the primary source of repayment, and should satisfy itself of the likelihood and adequacy of that flow. Net profit is often the principal component of the cash flow available for the repayment of term loans.
Again, which we'll see in the next part, where we talk a little bit about financial statements. So you learn some new things about what happens in the world of lending, especially once you move from consumer type loans to commercial and business type loans. So again, that is going to certainly introduce you to some of the other core aspects of the lending process, where much more money and circumstance and structuring is involved in the process. All right, thank you very much, Kaisha, for all that. I know it's a bunch of this and that, okay? But that was fine. What do we mean by mitigation? Anyone knows? Mitigation. When you hear the word mitigation, what do you mean? Let me put it this way. Always try to mitigate risk.
Make it smaller.
Yeah, make it smaller, reduce it. All right, so anytime you hear the word mitigate, that means try to resolve it somehow, make it smaller, reduce it, get rid of it if you can. All right, mitigate. Lawyers like to use that word. Okay, we may as well mitigate the situation by taking these steps. All right, don't thief, don't lie, and don't run. So like the police told you, and stuff like that. So yeah, so you don't create any more problems. All right. So the issue of mitigation comes up for the lender because the lenders will always be looking for any areas of risk, like credit risk, remember? Anybody remembers what credit risk is? Because I'm going to ask you that. What is credit risk? The risk that the borrower will not repay. Nobody should get that wrong. Anybody gets that wrong, I'm taking off an extra point.
No.
Say it wrong and just leave it wrong. Don't take off anything extra. Well, that's a given. I am going to ask you that question. So everybody should get at least what? 1 out of 100. You say, you better give 5 for that one.
Be careful with that.
All right. So lenders are always looking to mitigate their risk, trying to figure out which customers will pay and which ones will not pay. All right. That's what we mean by recognizing mitigation. If they do this well, they keep their bad debts to a minimum. Okay. If lenders do not mitigate the risk very well, if they do not analyze the credit properly, if they do not structure the loan the way they should, they're definitely going to
write-off.
Significant in some cases. Depending on the size of the lender and the size of the loan, write-offs can be in the millions, which happens every year, by the way. Pricing, of course, has to do with what? Interest rates. We know that the greater the risk we present to the lender, the higher the price of borrowing. The interest rate is going to be higher. The lower the risk we present to the borrower,
the lower the
absolutely. Very fundamental principle. You don't need to be a rocket scientist to figure that one out. Okay? All right, and then the financial covenants, why do we ask? Malik, just this little paragraph, can you read that, financial covenant?
Financial covenants are frequently included in the agreement between the lender and the borrower. They represent what should be the mutually acceptable standard of financial performance and to benefit the borrower and conditions the borrower will meet during the life of the loan. The number and nature of the covenant may vary from the borrower to borrower. Ideally, financial covenants should be set at such levels as to protect the lender in the event the borrower's financial performance and or condition deteriorates
materially, yes.
Right.
Which we've seen during the COVID period, have we not? In case you're wondering if this is real life stuff. It is. All kinds of covenants and agreements have gone to hell over the last 3 months. And people have gone to hell, covenants, loan, everything has gone to hell, by the way. Still in hell. Some more will go to hell before this whole thing is. Yeah, I understand Cable Bahamas, that a gang of people go again. The hell they're supposed to go. Anyway, that's their problem. Keep going.
Conversely, they should not be so restrictive as to be subject to frequent violations resulting from materially insignificant or periodic financial reverses, more or less in the normal course of business. Not only do well-structured financial covenants serve of protection for the lender, but they may also buffer the borrower against
capricious. You don't see that too often.
Yeah, capricious adverse action by the lender.
Indeed.
Government contractors are better served by lenders that understand the industry well enough to be able to structure loans effectively for their mutual benefit. Good loan structuring is a win-win situation for both parties.
Thank you very much. I just want to make the note here, again, that this financial covenants thing is really just putting all the agreements in place that is going to be satisfactory for both parties. Sometimes some lenders put agreements in place that are very restrictive on borrowers, and eventually they try to force the borrower, if you want this money, sign here, whatever. The borrowers, but this is not good for me. It's gonna hurt me later. I don't care. You want the money, sign here. And then later on, all hell breaks loose and everybody suffers. Okay, so these covenants or agreements between buyer and seller has to be, sorry, borrower and lender has to be such that it is significantly good for both parties. Absolutely. That's the key. You can't act like God all the time if you're a lender and put the borrower in a jeopardizing position, and eventually they cannot pay you, and then your greatest risk.
Have a bad debt.
Of course, your greatest nightmare comes to play. Credit risk turns into bad debt, and bad debt turns into write-off. So you don't mind, bad debt is bad enough, but as long as it's a bad debt, you can still run them down and then like money, pay, sue, legal action. But once you try all that and nothing happens, then you have to what? Write it off. Take it off your books completely, which means that for all intents and purposes, you're not going to make any money off that. Or you're certainly not going to make the money you thought you would make. Okay. So for example, if you give a 5-year loan to a company or a person and the interest is $7,000, halfway through the loan, you collect about $4,000. And then the loan starts going bad, that puts the other $3,000 what? In jeopardy. Until you finally call and say, may I speak to Tom Jones, please? Man, he gone to New Zealand where you know COVID. Yeah, he skipped town. So all of a sudden, you're never gonna get this $3,000 ever. Unless of course he runs back to the Bahamas to duck COVID in New Zealand and come in with a sorrowful heart, God forbid. Not likely, but every blue moon. But other than that, you're gonna lose that 3,000. Or if it's a huge loan, 3 million. Or if it's a really, really bad situation, 3 billion. Let's not forget, lending is not only about nuts and bolts. Like it's $3,000, $5,000, $10,000 loan. It's about gazillions and billions as well. But the principles of lending and structuring don't change much. It just varies according to nature, purpose, amount. Remember those elements? And that same little paragraph that we rushed over. Not rushed over. I just pointing it out to you. Anybody remembers what that paragraph was? The elements?
Right there.
If I were you, I'd put an asterisk there.
3 asterisks.
Because you never know if a question is coming.
That is coming.
Okay? It's, she said, look, man, all these coming. I'm even putting an asterisk just to help you.
Structures involve several
That's what you call a hint.
Including purpose, amount,
and so on. So 2 questions you know are coming. Credit risk and that one. How about that? So that's like 7 of 100 or so. All right, moving right along. Now we're into the final stage of the lending process. We've already talked about all the foundational structural issues. Now we're going to talk a little bit about the credit analysis side of things, which always begins with the credit application. If you're not familiar with the credit application, I gave you a sample in your folder. I hope you looked at it. God forbid if you've not looked at it yet, glance at it now, quickly. And if you can't glance now, make sure you
in the book. 2 pages, 2 pages, go 2 pages.
Yeah, do like Cooper like this.
Don't do like Cooper.
Yeah, you like Cooper in the collection side. All right. So if you've never seen a credit application in your life, yeah, flip 2 pages and you'll see basically what it looks like. We'll talk about a little bit about that later on. But that credit application is designed to get all the basic information from borrowers, okay? So that the lender can then have all of the information that they need
to run you
down. To either say yes or no, and to find you if you become a what? Credit risk. All right. who didn't? Tanisha. Not Tanisha.
That's Tanisha.
Not,
That's the
is
right
it, did I
one.
say that right, Tanisha?
Yes, you got it
Tanisha,
right.
have you read yet? Doggone it. Okay, let it rip.
Credit application. A credit application is a form used by potential borrowers to get approval for credit from lenders. Today, many credit applications are filled out electronically and may be included in a short amount of time. Once you fill out an application, the lender will pull a version of your credit report and/or credit score. They will use this credit profile and other factors like your income or debt-to-income ratio to determine if you meet their underwriting standards. Credit application form. Whether you're giving out business loans or individual loans, automate your credit application process to approve lines of credit faster with an online credit application form. Simply customize the form template and embed your customized form into your website to start accepting credit applications online.
So nowadays you guys can actually go online, fill in your application, do all that crap, even certain parts of the world. We're working on that. We haven't gotten charged with that, but we have some version of that in the Bahamas already. In the old days when I was a lender, we didn't have any of that crap. You come in, yuck out your doggone credit application, write every Jesus thing Ram used to say. Everything had to be written manually. Nothing was electronic at all other than WordPerfect, which was out before Microsoft. Okay? And stuff like that. All right, keep going.
Whether you work for a bank or credit union or you're an independent lender, streamline your credit application process with your credit application forms. No more time-consuming in-person visits to approve credit loans. Mortgages, car loans, home loans, small business, or corporate loans. No matter what kind of credit you offer, customize your personal or business credit application forms to include your unique terms of repayment, update funds and colors, and add your company logo for a personal touch. You can even link your form to a PDF template to automatically generate loan contracts as professional PDF documents. Create a seamless credit application process from beginning to end by starting out with a free custom online credit application form.
And I just threw that in there just to show you that credit has become a very modern thing now. You can do all this crap, depending on where you are in the world, online. And we're working our way to that eventually. God forbid. All right.
Credit applications allow lender support on each account that is established with them. They report the type of account, credit card, auto loan, mortgage, etc. The date you open the account, your credit limit, or loan amount, the account balance, and your payment history, including whether or not you may have made your payment on time.
Now, just bear in mind, see that little paragraph with all that powerful stuff? That's essentially what the credit bureaus will be seeking from banks in the Bahamas to get information to set up the credit bureau. And they will use the same information to make an assessment on how they're going to score and come up with this credit scores. And then they will then evaluate whether certain persons are eligible for loans in the future or not. I heard somebody say that they will not be looking at people's past histories going forward. That's interesting.
Make no sense.
Who are they trying to appease by saying that?
I have no idea.
Interesting. I wonder what that statement is all about. All right, keep going.
Credit application process.
Sorry?
No, they can get your utility information out of.
Absolutely. What do they need your utility information for?
To find out how you pay.
Yes.
Your credit worthiness. Repayment.
I agree. Again, how this whole thing is going to unravel is going to be as sketchy as the thing itself in part. There are a whole lot of things going on that will be known and unknown to us. All we're going to be doing is only those who need to know basis, like some KGB operation. You try to find this, a need to know basis. Who the hell are you? Potential borrower? You don't need to know. On it. Just give, shut up, and answer our questions. This is democracy, but do it. Or else, because if you don't do it, we'll start acting like a non-democracy towards you.
Okay. Can't get no loan nowhere.
Yes, so let us turn Chinese on you, just answer the question. Okay, keep going.
credit application is a request for extension of credit. Credit applications can be done either orally or in written form, usually through an electronic system. Whether done in person or individually, the application must usually contain all types.
Pertinent, yes, meaning important.
Relating to the cost of the credit for the borrower, including the annual percentage yield, APY, and all associated fees.
In other words, a lot of times people try to do credits and other deals without telling the person who's borrowing or doing business everything they should. They just do everything, say, sign here. And people are so excited to get the money, they say, where? They don't know what they're signing, and nobody tells them anything, that their interest rate is gonna be 27%. And all of a sudden, they can't ever finish paying, the payment is high, the interest, they don't even
Ain't in the
know.
contract, ain't in the welcome letter, it has to be.
Maybe,
Welcome letter.
but who's gonna read them out? They do like this. Thank you for that check. When they leave it, it's a welcome letter.
Oh, my.
Throw it in the garbage.
Just sign something.
Welcome letter?
Now, let me take that back, because I know somebody who brought, say, this is no more, I pay them all of this, and this is what I say, but your per diem is $10 a day.
This, excuse me, miss, what you mean by per diem? I figure you all tricked me, keeping my money, see? Per diem? Per diem? Man, people who are doing stuff in the per diem, miss? What the flick? Then they start using the word. Why ain't nobody tell me about the per diem? and what that is? Then the shoe. Well, per diem has to do with the daily per diem. Say they know, miss, I was off them before I asked for per diem. Because you look like you stupid too. I still don't understand nothing.
Your daily interest rate?
Yeah, call it manager. Absolutely. I asked you for per diem, you say per diem? Get upset. I figure I'll keep them. Okay, keep going. Just again, I'm not going to tie you guys up in all the compounding side of things in this particular first part. This is not designed for this. You just need to know that the annual percentage rate is the typical rate that is used. The annual percentage here. Yield is the typical rate of interest that is used for lending purposes. And in most or all cases, it should be disclosed clearly to the customer. So if the annual percentage rate is 12%, they should know it's 12%. They should know it's 10%. Don't have any hidden stuff in there where you say 12%. Yes. What is my rate? 12%, miss. But you don't tell them that when you compound all some other things, it's really 17%. Customer oftentimes may not know that. If that is the case, they should know. There should be no deceit. See that word? Do not mislead. Just so you don't want a customer to lie about information they give you as a lender, you should not lie to your customers. Yeah. Okay, keep going.
Unlike simple compounding interest is calculated periodically and then not immediately added to the balance. With each period going forward, the account balance gets a little bigger, so the interest paid on the balance gets bigger as well. The following are 2 points regarding the annual percentage yield. 1. APY is the actual rate of return that will be earned in 1 year if the interest is compounded. 2. Compound interest is added periodically to the total invested, increasing the balance. That means each interest payment will be larger based on the higher balance. 3. The more often interest is compounded, the better the return will be.
Now,
we have these kinds. We have compound
interest
loans.
Yes, some lenders do. Absolutely.
Yeah.
Yeah. Sometimes they have the compounding occurs within the loan interest rate, or sometimes the compounding might occur outside of the interest rate, but they may not necessarily tell the customer. We shouldn't see it, and those who do it should what? Disclose it. Absolutely. But you won't see a lot of that happening, say, here, so to speak. But we do have it happening in and around the world of lending. Okay, by all means. Just so you have compound interest for savings.
Deposit.
Yeah, we do have compounding of interest rates as well. The key is lenders should what? Disclose this. Because just so you earn more if you compound interest on your savings, you're gonna pay more if it's compounded on your loan. Absolutely. All right, so the question I'm likely to ask if I ask an APR question is, what are the 3 key points regarding APY that we discussed? And you just say, one is the actual rate, one is the compound, and one is what? Yeah, that's all. See that? No big sweat. I'm not gonna ask you, following that answer, please give me an example of the compound. No. Okay, by all means. Okay, keep going.
APY is similar to the annual percentage rate used for loans. The APR reflects the effective percentage that the borrower will pay over a year in interest and fees for the loan. APY and APR both standardized measures of interest rates expressed as an annualized percentage rate.
Indeed, because sometimes what happens is when rates are expressed as APR, APY, you might just be given the rate minus any fee charges. But if there are fee charges and they are included, then that will compound the rate and make it more that you repay. Again, customers need to be made aware as to whether or not fee charges are included in the APR, APY or not. If it's not included, then it's not compounded. If other rates and fees are included, then it's a compound situation and the customer will, at the end of the day, end up being paying more. Okay? This is why it is so important for lenders to be clear with their customers about what their interest rates are, whether it's compounded or not. Okay? It's very important. Okay.
Credit application processes are increasingly becoming faster and more automated as new financial technology systems emerge in the credit market. Technology also, allows lenders to offer borrowers varying types of credit applications that can be done either in person or individually. Regulation B governs the disclosures provided in credit applications for borrowers and provides for consistency across all types of loans. Technology also allow borrowers to complete a credit application completely on their own through an online application.
Sometime in the future, in the Bahamas anyway, but around the world, it's happening.
Credit card applications are typically processed through an online credit application, often providing the borrower with an immediate approval.
Do we have that in the Bahamas yet? Immediate approval. Not yet. You could fill it in online, but immediate approval? Go sleep and wait. Yeah. An immediate response based on information? Yes. We don't have that yet. Okay. Keep going.
Banks and emerging fintech companies have also increased the online lending options available for borrowers. For borrowers who seek more personal interaction, traditional bank lenders offer branches across the nation with customer service representatives available to help borrowers in the lending process.
Thank God, that's us. We still want to talk to people.
Some banks even offer telecommunicating services for discussing loans and completing a loan application over the phone. This type of service is a part of the traditional bank model that includes more personal interaction and banking services. Typical loans that borrowers may seek to apply for in person can include bank lines of credit, mortgage loans, and home equity loans. In all types of credit applications, the information requested is typically the same. A lending decision will be based on a hard credit inquiry, which provides details on a borrower's credit score and credit history. In addition to credit scoring, lenders also base loan decisions on a borrower's debt to income.
Did we discuss debt to income?
Yes, we did.
Yes, we did. I could easily ask you a debt to income question, but it won't be like some big time doggone mathematical computer generated. No. If I ask you about debt to income, I might say in the lending process, what do you understand by the term debt to income? What would you say?
Comparing your debt,
the total amount of payments that you have outstanding to
your income.
The income. And then I might say, given the following information, calculate the debt to income. Then I'll give you total debts and I'll give you total income and then you calculate. See that? Simple as that. All kinds of points for nothing. Not nothing. It's nothing if you know. It's a big problem. You say, I'm not doing any debt to income. I'm ignoring that issue. Well, I'm telling you, I might ask you about that, so just be ready to do that just in case. Okay. Keep going.
Mainstream lenders will typically look for a credit score of 650 or higher with a debt to income ratio of 35% or less.
That thing. What is our debt to income ratio? The debt to income in the Bahamas?
45%.
45. Doggone these other people. Okay. And then we'll soon find out about the credit score thing. Because who's doing our thing again?
The credit
The
bureau.
Italians who are, no, the Italians who have COVID.
Right.
So they come over here getting information, bring COVID down. Man, you can't win for losing. Anyway, keep going.
Each individual lender, however, will have their own standards for credit underwriting and credit approval.
Which we already know. Every customer is different. We have to apply these principles and elements to each customer individually, whether it's a person, a company, a mortgage, or whatever the case might be. All right. And then finally, Tanisha, Regulation Z.
Regulation Z is like a legislation that governs the requirement of credit details to borrowers. This legislation was established as part of the Truth in Lending Act of 1968.
Do you have any truth in lending in the Bahamas yet? No. Maybe after we get COVID from the Italians, they set up the bureau, then we'll set up legislation truth in lending. Okay, keep going.
It is enforced by the U.S. Federal Reserve Board and the Consumer Financial Protection Bureau. Regulation Z helps to provide consistency across credit disclosures.
Yes.
This consistency is expected to protect borrowers from being misled by creditors.
Correct. Yeah, see that? To protect borrowers from being misled by lenders of any kind, whether it's the bank, credit union, then the lending house, the other house, the outhouse, whatever. Because that means that lenders are not always truthful when dealing with whom? Borrowers. And this act was established to protect them. Imagine that. My. And then finally?
While also helping borrowers to better understand credit terms and more easily compare borrowers across lenders.
Thank you very much, Tanisha. So that mouthful was a mouthful and a handful, but it does give you some insight on the credit application process. And we talked about all these different online, offline, people, no people, Rover, so that you understand how important this credit application process is. It's designed to capture upfront all of the relevant information that the lender needs from the borrower to make that good decision. Now comes the other part of the lending process after you get the information. Now, the credit investigation comes before the approval as well. The application is first, then the investigation. No approval yet. The investigation is designed to do what? Check all that crappy information that you have on that what? Application. And all we're doing for the next page or two is talking about where do we go to investigate. Investigate all the personal information they gave you. My. Name. Address. Job information, financial statement, whatever, all the personal data, check it out. Then call our credit bureau that's being established by the COVID people. See what the information there is. Is it positive or negative? Then check where? What's the third thing on the page? After the credit bureau.
Checking banks.
Bank checking, check the banks. For what?
Is the person.
How much loans they have.
Yeah, loans and deposits. Well, the credit bureau will tell you if the credit bureau is not in place yet in the Bahamas, then we can check the banks or whatever they might have maybe.
Some of them, they don't put anything.
Who?
Some of the,
Credit bureau?
no, I'm saying, when some of the customers, they'll tell you they have no loans.
That's true. But that's why the credit bureau is coming now, so that you can have information on all. So when the customer doesn't disclose, the bureau will have that information potentially.
Hold on. Banks is tell other banks you have deposit there.
Sometimes, but they don't say what the amount is. And they don't say what it is at all. This depends on the bank. And they say if you want information, let the customer give written instructions. So that's how you can get it if you need it.
your private secrecy. law.
Absolutely. So some banks will say in the low something, in the low 300,000, a high million, whatever. Other banks will say, we can't say anything, sorry. The customer has to give authorization. And so then you have to call the customer and say, look, I need you to authorize your bank to give me the information that you said you had. And the customer, I authorize my bank, then you know, the customer's buying about something. Okay. If it's a business loan, verify the business. Is it incorporated? What's the deal? What's going on? What is the income, expenses, profit? All these kinds of things. Find out everything you need to know about the business. Is it a partnership, sole proprietorship, company? Anything they tell you in that application, go out and check it. Whoever you do business with, trade verification, check it. Employment verification, check it. Make sure the employment data is legitimate. People bring employment data that are not true.
That's why you have to call. You have to
You have to call
HR.
them and they say, think I'm gonna call you. And she calls, you're like, wake you up.
And I made this.
Yeah, like this amount.
Don't
They know
call
someone
any
in HR too.
particular that person in HR.
Yeah, people know people in HR.
Yeah, but you think they can jeopardize their job?
Depends on the depends on the what? Relationship. Now, if a stranger walking like one of us, can you please say, yeah, that's stupid? But if that's there, something. Whatever. Of course. Of course. I had a guy came to me the other day.
Millennials, be treat check. You call HR, you get the job,
Yeah.
the job letter
Yeah.
and salary.
That's the best
salary
you could
pay
do.
slip.
So if somebody go to trouble coordinate all that crap, then they should get away with it, I guess. But yeah, that's what you do in order to make sure that your employment verification is complete. It's not a one step. In the old days, job letter. You took that, that was gospel, company stamp, bam. Now people sneak the stamp. People even come with false COVID. They presenting false COVID before they have somebody do, hey, pay someone to stamp it, sign it. How about that? So there's always some crap going on with folk. Okay? That's what, yeah. This is why the investigation has to be done. It has to be done as thoroughly as possible. If they're getting rental income, do whatever you need to do. Call thing and check thing, get something in writing, have it notarized by 2 lawyers and another sub-lawyer and another QC and all that. Not really. I'm just making a point. Verify it to make sure it's correct. Okay? Rental verification. Because somebody goes, do you have any other income? Yes, rental. How much? $750. When you check it, it's $250. Or not at all. You have to check if you're a lender. Court case. Any bankruptcies for if you're borrowing corporately? No bankruptcies ever. You sure? Never, never, never? No, sir. Ma'am. And then when you do your verification, what happens? You have 7 bankruptcies in the last 3 years. Okay? So be careful. Now, what kind of question can I ask an investigation? List and describe 3 or 4 steps in the investigation process that you should check. You know, it's 1 less. When I say 3, say 2. When I say 3, she says, when I say 3, say 2. When I say 4, say 3. There you go.
3 steps.
All right. So check the courts if there's a question of bankruptcy involved with your business client who's trying to borrow money. And again, the nature of your verification and investigation will depend on the type of loan that you are seeking to give to a certain type of customer. So it goes all the way from the individual all the way up to the corporate type of loan. It goes anywhere from $1,000 to millions, depending on the type of loan. All right. Now, for those of you who've never seen a credit application, I just kind of put this here so that you could take a look. I notice it has some peculiar information, doesn't it? It has information on whom first?
The borrower.
Yeah, the applicant or the borrower first. Then it has information on the borrower's what?
Relative or?
Before the relative.
Employment.
Yes. Then information on the if somebody's signing with you. Because remember, if somebody's signing with you, that's kind of like a guarantee, isn't it?
Yes.
So if something happens to you as the principal and you don't pay,
go to the co-borrower.
yes, whoever else signed We're coming after you. Oh, got it? That's why when husband and wives get back, somebody, I ain't paying that doggone thing no more. You better go find money. Well, because the spouse said that, doesn't mean that they're no longer liable. But if they say it and disappear, then you have a problem, Houston. Some spouses say it and try to just hide. But whoever's on that application, they're all going to be liable until somebody can be found. Does dying help? No. If both parties die or a single borrower dies, what do you think is going to happen?
Dying may help,
Maybe.
especially if you have a life insurance.
Absolutely. I was teasing my wife the other day. I said, whenever things get too tough during this COVID, I don't know, whatever poison you give me, make it swift. And then go and collect. They don't feel well about it at all. In fact, they're finding every way to get out of it. They're making you prove, first of all, they're saying that if the insurance policy does not cover COVID, which it doesn't, then they're going to be reluctant to pay. Then you're going to have to sue. And then they're going to have a big court case depending on the situation, depending on the jurisdiction and the world you're in.
No problem taking your premium.
Which didn't include? It's just like when you go to buy house insurance. If you don't buy earthquake, mountains falling, even though we don't have that, they tell you they can't cover you. And this means we don't earthquakes, yes, sir. Take that out, give me a lower premium. Sorry. This doggone thing is for the whole world. And even though we don't have earthquakes in the Bahamas, you still have to pay the world rate. Yeah. If you don't like it, lump it. And if you don't pay, we'll call your bank and report you bastard, and make them debit your account for even higher premium. Stinking borrower. No, I'm just being facetious. Okay, but these are the things that will happen in real life if you do not follow through. Okay, that's how it works. Also, the bank will want to know what else. Do you have any credit cards? Yeah, what are your assets? What do you own? What do you owe? Who do you owe? Do you have any credit cards? Do you have any mortgages? Do you have any other debts anywhere? Do anybody anywhere? Credit unions, the other union, people, whatever. Whatever they are. Yes. And so you see this application is designed to be complete. By the time they finish taking this information, they should have enough information to verify and investigate and make a credit decision. I remember a credit decision has two parts. Anybody knows what the two parts are? Say it again. What are the two parts of the credit application? Yes or? I know the obvious. I know the obvious. All right. So I need an online reader now. Who didn't read last time? Laurie, did you read?
Yes, sir.
Janine. No answer.
I read.
Yes, sir.
Janine, did you read?
Not as yet.
Not as yet. Wonderful. Can you pick up for us then on credit evaluation and the application?
Yes, sir.
Okay, let's let it rip. Yes.
Central to the function.
One second, Janine. We have a crisis.
Okay.
I'm wondering, where does Janine have to go though? Are you married? I mean, not Janine. Malik, are you married?
No.
No, but if I'm gonna take that, I'm gonna move it on.
11.
10.
Oh, it's 10 now? Oh. I'm just being the devil's advocate. Oh, got it?
Oh, Lord, that's me.
Okay. If you need to go with Malik, so just remember.
Did you ask him to send the video in the morning so that?
Who normally sends the video?
Yeah.
Oh, if you don't get it by 11 o'clock, call him and make some noise like Miguel.
Sometimes
Oh. Sure, I'll send him an email and a text and ask him to send it first thing.
I didn't even know we have videos of this class.
Yes, indeed. We do have videos of the class. Miguel normally sends it. So I think you can go on YouTube and have a look at it if you want to. Okay?
Attached to the link that sends to the online class.
You still need to send me the second class.
Send the both in one email.
You didn't get the second one?
No, because I couldn't get on last week. I didn't reach in until like 7:30, and they said they were gonna.
Janine, I understand that both of them were in the one email that he sent that you may have gotten. You didn't see a second one attached to it? See you next week.
I'll
Just
double check.
Yeah, double check. If not, send him another blah, blah, blah. And if you don't get anything in 24 hours, send me a text or email and I'll kind of harass him along with you.
Awesome, thank you.
Okay, wonderful. Okay, let's go. Janine.
Credit evaluation, credit application. Central to the function of the credit department is credit evaluation. Evaluating the credit worthiness of a potential credit customer in an efficient, repeatable, and accurate manner helps to minimize credit risk exposure, protect margins, and maximize product profits. The first step and where much of the work is accomplished is through a good credit application.
Yes, which we just discussed. Keep going.
The first step is managing credit wisely, is to make informed decisions about which parties should qualify. Standardizing the credit process by having every potential credit customer, which may be every customer, fill out a credit application. Helps to create a standardized risk mitigation procedure. The first step is managing credit wisely to make oh, I didn't read that.
No.
Which a party should qualify. How much credit they should be extended and the terms thereof. Depending on the information in the credit application, the payment terms may be modified.
Yes.
Or some customers may not qualify for credit at all.
Absolutely.
While it may hurt to turn down a sale, if it results of the credit application don't meet your policy requirements, the actual cost of the non-paying client is much higher than the amount of the lost sale.
In other words, for many lenders, it is easier and better to decline a loan given the information that you have from the customer's application than to go ahead and stretch the loan to make it happen, force it to happen, and then all of a sudden, a couple of months later, the customer cannot repay for some reason that you kind of anticipated in the first place, and then the loan starts going bad. Okay? So even though you might feel sorry for the customer, you might know them, you'll be related to them, you might have gone to primary school with them or whatever the case might be. Some customer situation, once you see that application, gives you a clear indication that you should not do it. And when you have those situations as a lender, you should not do it. Okay? Keep going.
As well as contacting the credit references listed in a potential customer's credit application, it can be a good idea to run a credit report. There have been several previous posts on the construction payments blog, documenting important parts of credit applications. But at the least, credit reports provide a nice snapshot to help make credit decisions and should be a standard part of a proper credit application.
Which is primarily one of the reasons why we're getting the COVID-infested Italians to establish a credit bureau for the Bahamas, so that when we get this credit report from them, it'll be a fundamental document in terms of the credit decision we need to make. They somehow feel that It'll create a more efficient situation for lenders, that lenders don't have to be all over the place trying to get information, trying to figure out who's lying, investigating the rat in the hole and the cat in the attic and all this kind of stuff. That this credit report will cover a whole lot of all of the important information that lenders will need to make a yes or no. Okay, keep going.
Information to be included on a credit application may include
Yes.
contact information, credit information, credit report of the business, and potentially of the owner as well. Should be pulled, obviously, dependent on the potential customer. To accomplish this, you will need to EIN for the business and an SSN for the owner.
Anybody knows what they are? EIN, SSN? For the business is EIN. Yeah, it's like a TIN number. Okay, employment, employee information.
And the SSN, what,
number,
Social Security?
and then the SSN is the Social Security number for individuals. Absolutely. Okay, keep going. So contact information, credit information.
Landlord and or mortgage holder references. If the businesses doesn't pay their rent or mortgage on time, you likely won't get paid on time either.
True or false?
True.
Absolutely. That's why it's important. Keep going.
Bank and or trade references. Same thing applies here. The clearer picture of the customer's financial picture appears with every new piece of information.
For sure, anything coming from the bank or the trading houses relevant to the business that you're giving a loan to will always help. Are they good, bad, or ugly? Keep going.
Payment terms. You may wish to outline your general payment terms in the credit application itself. Clearly, though may potential modification to the general payment terms would then need an additional signed document. You may wish to keep the two separate as well. Once a credit decision has been made, the terms can be set and agreed to in a separate document.
Absolutely, and those payment terms are absolutely critical because they can't be so long that the bank takes too long to get its payment, the lender, unless it's a mortgage. And it can't be so short that the payments are so high that the borrower cannot afford to pay them. So we need to find a middle ground somewhere, and this is where the lender's skill and experience would come in to play. Computers cannot do that part of the work. Okay, keep going.
Co-applicant personal guarantee. A personal guarantee or co-applicant added to the credit application gives you an added layer of security. The potential collection tool. Nobody extends credit to a company that they think won't pay. But the personal guarantee of the business owner or contracting party can sometimes provide an extra push to receive payment.
Yes.
Note, however, that this is likely not an option, nor would you generally want to include it when dealing with a larger potential credit customer. Credit analyst.
Credit
analysis.
Yes.
Analysis is the method by which one calculates the credit worthiness of a business or organization. In other words, it is the evaluation of the ability of an individual or company to honor its financial obligations.
Absolutely.
The credit risk assessment helps lenders know whether to borrow can pay back, whether the borrower can pay back a loan. The credit risk of the consumer is determined by the 5 C's: capacity to repay, associated collateral, credit history, capital, and the loan's conditions.
Thank you so much, Janine, because that part of your discussion takes me in to my final notes for the lecture this afternoon that has to do with the 5 C's of credit. They are so fundamental to the credit evaluation process, as is everything else you have mentioned in the last 10 minutes. But these 5 C's, if applied effectively by lenders, they'll find that it will be a great source of help and comfort to the lending process, no matter what type of lender you might be. All right. So the first C of credit that is absolutely crucial is that of capacity. And capacity has to do with the borrower's ability to pay. Yeah, to pay the loan. Do you earn enough money on a consistent basis to pay the loan over the term that you want the loan for potentially? If somebody's a gypsy and they want a mortgage loan, they're gonna have a problem with capacity because gypsies tend to do what? Travel, move around. Okay, so while they may have some money because of a show they put on last week at Bahama, the capacity going forward would be questionable. Okay, ability to pay for the term of the loan, not just 1 or 2 loan payments, but for the entire term. Okay, then there's capital. Capital has to do with what? Yeah, what you have to start with. Yeah, like what is the borrower put? Yeah, what are you putting into it? All right. In the old days, if you wanted a car loan, you could put in 20%. You wanted a mortgage loan, 25% or 30%. Nowadays, 10% and 5%, but you have to put something in it. And the whole reason for the capital is so that the borrower can make a commitment to the proposal. The feeling was if you put something into it, you wouldn't treat it so lightly. Human nature has a tendency, if you don't put anything in, you don't give up, flying fish, generally speaking. So banks prefer when borrowers have more capital to put in than less capital, more to commit to the loan. Okay? That way, every time it's time to make a payment, you think about that hard-earned money that you had to put in as a down payment. And so you have a sense of stewardship, ownership. I'm a part of this thing. My $40,000 has gone in. My 20 has gone in. My 10, I'm not about to take this facility lightly. I am committed because of my commitment. Okay? That's what capital is all about. Then there's the C of conditions. Okay? The conditions are the conditions in terms of the loan itself. Does the loan have the proper term? Is it long enough for the customer, short enough for the customer and the bank? Is the interest rate suitable for everybody involved? All right, are the charges suitable? What are the terms and conditions acceptable to both parties? Is the covenant or the agreement suitable for both parties such that one does not have an unfair advantage, God forbid, over the other? Okay. So the conditions are absolutely crucial, as well as capital, as well as capacity. Then we have character. I don't need to say much about that. Character is about what? Credit worthiness, credit history. There's a long set of paragraphs about character because a lot of times some lenders believe that those customers with great character don't need anything else. They're going to pay. Those type of persons, though, are difficult to determine unless you have some what? History. Okay? So character is oftentimes a function of the historical credit or the credit worthiness of your client. Okay? Character is a very subjective term. It's hard to determine who's good, who's bad, and who's ugly unless you are able to look at the situation over time. That's why history is so important, credit history, to determining the person's character. If you had a customer for 5, 7, and 10 years and they paid well, and something happens in year 11, you're still going to consider that customer because of their credit history. You know they've been good. If something goes wrong, something has happened, you work with them. And then finally, the last C of credit, which is called collateral. Collateral, banks do not necessarily take collateral because they think it'll make somebody a better paying customer. Some customers will give you all kind of collateral when it's time to pay. They still pay badly. But collateral is designed for what reason, you think?
To secure the bank.
Yeah, to secure the bank's interest in the event that the customer does not pay.
Delinquent.
Yeah, for any reason, purposely or not. at least the bank has a contingency in place called collateral. If you do not pay, yeah, they can sell it off and seek to pay off the loan balance, okay? So if you're a lender of any kind and you want to really give some meat to your evaluation process, and again, the credit evaluation process is so critical to the overall process, because if you get that right, you're probably going to do some good loans. If you get that wrong, using these C's, the 5 C's, you're probably going to get some bad loans, lose some money, write off some stuff, and so on. Okay? And remember, depending on the size of a lender that you are, those losses could potentially be hundreds, thousands, millions, billions. Okay, for sure. All right. Since you guys have been so great and stayed with this whole thing right to the end, what I'm going to do is the examination will be up to and including collateral. I will not test you beyond the collateral for the test. So please go ahead and prepare yourself all of the information up to the 5 C's of credit. Okay. The other few concepts, we'll pick them up after the examination and then go into collections. Okay. So the other stuff under credit, under collateral, we'll pick that up after the examination next week and then move further and on to collections the following session. All right. So again, if you have any questions during the study period up until next week, please send me an email, please send me a text. Remember, the examination is going to be primarily definitions, a couple of true-false questions, and short answers. Okay? Feel free to contact me at any time if you have a concept that you're not clear on, that you'd like to get clarified before the examination. For my online students, have you gotten any information from Miguel and Company on how you will write your examination?
No, sir.
Wow. Okay. Yeah. I'm going to bill them for this extra administrative thing. Here's what you do. What is going to happen, I'm going to have to drag Miguel in here next week. They have a special examination testing software where they will upload the examination to the internet, send it to you. You answer the questions online, and when you're done, you hit submit, and your examination will come directly to Miguel, who will send it directly to me. Okay. So yes, please make sure that you are ready and present at 6 o'clock next week, so that when we upload the examination, that everybody can get it at the same time. The only difference is you will have to turn on your video so that I can see you, so that you're in the same examination setting as the persons who are here. Absolutely.
No problem.
So, yeah, nobody moves, nobody gets hurt.
Open book. I think.
No problem.
So
yes,
I'll see you guys next week. And remember, I'm available to answer any questions you might have during your study period before the examination next week. Okay?
Thank you.
Wonderful. I'll see you next week, and good luck.
All right. Thank you.
You're welcome. Hell no, there's no fun in that. That sounds so boring to me. I don't know what to do with myself.
No, but then you also have an open book there.
I know, I know.
So when you when you gonna
In September. Well, it might be a little before that. Might show up like around the middle of August. So be on the lookout for it. I heard September, but I agree with you. I think that's kind of already happening, right? Yeah, like you want to do it while you're on the road.
You're on the road, but people may have to do stuff. That's all the
So,
thing is
yeah,
starting
so
the school.
it'll probably be like the end of August.
Yeah.
Okay, so that everybody can unruffle. Okay, take care. See you next week. Good night. Take care. Good luck. See you next week.